Welcome. Welcome, everyone. I'm Angelo Robles, and welcome to at FamilyOffice, at FamilyOffice TV. For old school podcasters, Angelo Robles Podcast on Apple, Spotify, and others, and a special welcome to my members of SFO Continuity. This has been an incredible week. It's been a very active week and very stressful for many. It's been the presidential election. So I don't know when you're going to be hearing this. If you're hearing this live, it's right in the moment, but maybe a month from now, a year from now, we could go back and reflect. So the title of today was Buffett, Harvard, Tesla, and Nuclear Renaissance, Non-Consensus Investing in Public Markets. Those are all things that we're absolutely going to cover and then some. I couldn't make the title big enough, but I think it'd be wrong and remiss if we didn't bring in the fact that a major election occurred in America. There's lots of insights from it, and actually lots of elections this year around the world, and what's going to be the impact on economics, the markets, stocks, really everything. So this is going to be a very long form encompassing conversation with a very special guest who I've known for 15 years. He's one of the most common guest on my platform, and I haven't seen him in years until latter part of this summer. I did a SFO continuity breakfast for my members, and Ram was a special guest, so it was great to see him. On that note, everyone, roll up your sleeves. This is going to be incredible. We're joined today by Ram Ahluwalia, CEO and co-founder of Lumina. Ram, welcome to the show.
Thank you again for having me, Angelo. It's always a pleasure.
Thank you. Thank you. We have a lot to get to and going to get initially a little bit off track relative to what I had in the title, as I mentioned. But I think we basically have to start with a very blunt, direct question. Trump won. What does that mean? Who are going to be the winners? Who are going to be the losers? And effectively, what's going to be the impact on the markets?
Sure. Like there's a political implication. There's an economic implication. I'll start with the former. And like my views here as like an analyst, 48% of the people not happy with the outcome, 52% happy with the outcome. So from the DNC level, I think the progressive wing of that party is a clear loser. Okay. So the strategy of student loan debt forgiveness, it upset people that actually vote. It appealed to people that don't vote, number one. Number two, the attack on digital assets, Elizabeth Warren's crypto anti-army, that didn't work. That summoned a wall of money and motivated people to take action. The overreach around regulation has been felt from the SEC in not just public markets, but private equity as well. I know quite a few bank executives. I can tell you that the way the FDIC and the OCC has handled bank regulation it was pretty severe. So I think the progressive wing of the Democratic Party took a big L, and the DNC will have to recalibrate to the center, and that's healthy. That's healthy to have a two-party system with competitive electoral dynamics. They fundamentally had a misread on the American electorate. And by the way, I'm not, Monday morning quarterbacking here. Shortly after Harris was the new nominee, I noted that that's the ideal competitor Trump could face off against. And then on the night of the election at 6 p.m. Eastern, before results rolled in, I wrote the postmortem on the Harris campaign. So I think if you were looking at this closely, you could see that, the DNC was offside. So I'll pause there before we get into markets.
And following up a little bit on that and pressing it a little bit, could I make the art? One, I agree with you. And I think it's pretty obvious that America voted. But I'm going to take a little bit of a contrarian perspective relative to that. By the number of electoral votes, it was a moderately dominant win by Trump. But it came down to about 7 swing states, and at least in 5 or 6 of those swing states, including the blue wall, it was very, very close. So a little misleading. Yes, I know you could look at the charts that show counties around the U.S., and it feels like 80% plus was red. But again, the big cities. So could I make the argument that she made a lot of mistakes, arguably the wrong VP pick? No question she would have won Pennsylvania if she picked Shapiro. It may not have been as far away as we thought. And do they really need to make that many adjustments, meeting the Democratic National Party?
The root cause is that she was the nominee. That's the root cause. She was not vetted through a political process. And she, as you pointed out, made a bad choice in VP, made a bad choice in campaign manager, and didn't have the political instincts that Trump did, such as the Joe Rogan show, and like the McDonald's stunt. And yeah, there were stunts, but they were effective. And that's how people are consuming information. I don't think this election was about race and gender, right? Female senators from Michigan and Wisconsin won. You know, Trump also had his most effective campaign too. I think that's a fact. It on both sides, they had self-immolation. I think through the summer, they're both making unforced errors. But in the October and the home stretch, I do think that the Trump campaign was dialed in. I do think they had to make adjustments, right? There was lack of clarity on policy. One of the few things that was very clear in policy was that taxes on unrealized gains would go up. And if you're a low information voter, all you hear is taxes are going to go up. There's lack of clarity on Israel versus Gaza. On the one hand, they're supporting Israel. On the other hand, they're supporting the protesters. What does that mean? Trump's policies, several of them aren't even practical. You can't replace income taxes with tariffs. You can't deport millions of people, but they're clear. And that clarity drives authenticity. And that's what the American electorate wants. They weren't picking up authenticity from the Harris campaign, is my read. And the DNC was taking a Big Tent strategy, trying to appeal to everyone and upset no one. And, you know, that didn't fly. You know, there was also just a broader vibe session around us. All that psychology, by the way, like real incomes are going up, stock prices are all-time high. The fact that they lost, given that, just tells you the lack of relatability or understanding of the American electorate. And also it tells you about how the DNC was believing too much of the content of the mainstream media. And I wonder how much of that is like self-delusional in a way. I mean, look, Trump won the popular vote. That was not consensus. That was not consensus. He won the popular vote. That's a repudiation of what you heard from pundits and mainstream analysts, right? So I think there's a significant recalibration that's required from the DNC, both in terms of policy and how campaigns are done. I think going forward, every presidential candidate, mark my words, they will be on the Joe Rogan show, and they'll be on the All In Pod, and hopefully they'll be on the Angelo Robles and non-consensus investing pod also. The first two high conviction, the last two my speculative 10x bets. But that's,
this was obviously a great election for a longer form podcast. Yay! It's too bad I don't have more subscribers. By the way, I reached out to multiple candidates from both sides, and the reality is, yeah, I could be a little quirky, a little bit unique. Yes, I love long form. I think I have a very pound for pound influential audience, but I just don't have the numbers. I get it. Tom Bilyeu, Chris Williamson, Joe Rogan, they got millions and millions of followers. They're awesome. I listen to them too, the All In podcast, all that stuff. But sometimes it is nuances unique, and the old boxing adage, pound for pound, does matter. I'm going to stay on some of these themes a little bit, because I think they're important. We could certainly make an argument, we don't know for sure, that there is a deep state. It probably to some degree controlled the process of Biden into Harris and a little bit controlling her election and what she was going to say. But I could also state that big tech, that traditional media, emphasis on traditional media, possibly, shockingly, even Wall Street, a lot of these are going to skew, and Hollywood, towards the control generally of quote unquote the left. And yet they still lost not just broadly all three parts of the US election, but like you stated, the total population vote, which goes to show you, one, the angst of the American people, the classic mistakes that she made. In theory, Democrats, shockingly, should almost always win. They kind of have the numbers relatively, quote unquote, at their side. Yet somehow, even with the efforts that I noted, it lost. Why? And what is changing other than long form podcasts to kind of disseminate and get the message out?
Yeah, like the demographic groups in every cohort went more and more red, right? Like Republicans made inroads to Latinos, while at the same time, 2 weeks ago, there's a comic in Madison Square Garden that was making fun of Puerto Ricans, right? Think about that, right? Trump still won. Didn't matter. And, I think it's a few things, right? Again, one is failing to understand the American electorate, and policy in the modern era has been increasingly giveaway based. Like, I'll give you this, you vote for me. Student loan debt relief is a good example of that. And it's become more and more brazen, right, around those terms. There are several quid pro quos that'll happen now that Trump is in office. We'll get back to Marcus in a second. Tesla will get his tariffs. Digital assets will get a responsible framework, which I'm all in favor of, by the way. That's great, right? Fundamentally, I think that in addition to policy, you had a candidate that Americans broadly didn't relate to. I talked to people of Indian descent that didn't relate to candidate Harris, for example. My nanny is Black, female, and theoretically be more in the Harris camp. I didn't ask her how she wanted to vote. I said, hey, if you want to vote, I'll watch the kids. And she didn't turn out to vote. She wasn't enthusiastic. So, but look, campaigns and parties they adapt, they're dynamic, they move, they're trying to capture more and more of the median voter. So they'll adjust. You remember the Southern Democrats, which were blue states during the era of the civil rights era. Now they're red states. Reagan was one of gave an impassioned speech around immigration and how it's the only country, not Germany, not Japan, we can become a naturalized American citizen and have the right to vote. So policies shift, right? Free trade was historically a Republican policy. Now America First it's not quite leading to protectionism, but it's consistent with the idea of having tariffs, right? So we'll see whether that's a tactic and a strategy for negotiation or a new way of rethinking trade. But all to say is, policies adjust. So I think you'll get competitive elections again, but it was an incredible misread, and it shows just how out of touch party leaders in the DNC were because they were consuming mainstream media content. And I think the other lesson is that polls are actually a marketing device. The polls don't mean anything. You pay for a poll to get a result that supports your narrative. And Polymarket was a source of truth. We saw Polymarket converging on the outcomes in real time leading up to the election, on the night of the election, while people on cable news networks were trying to do decision analytics. The markets got it right. It's wisdom of the crowd. So I think those dynamics, social media, crowdsourced truth, and how campaigns are run are going to be changed permanently going forward.
Yeah, I mean, the pollster was at Seltzer a couple of days before coming out with a significant lead in Iowa for Harris really raised some eyebrows. First of all, who are the people responding? Who are you targeting? Is it specifically a demographic that's going to skew to not being representative of the state, but representative of the people that you're conversing with? Or that would actually be quasi okay, although that is ignorant and shows that you're not a poll that I'm going to want to follow in the future. I'm afraid some people are saying, I don't know if they're right or wrong. I mean, are some of these pollsters effectively, Trump has elements that are just not likable. There are people that don't like him, and there might even be money and resources behind. I just don't know. I don't know what to trust. Therefore, the international betting markets and leaving it to the wisdom of the people may be something that I'm going to rely more on, that has proven more accurate than pollsters that may have skewed perspectives, or the demographic they're talking to is going to skew either way, maybe left or right. I don't know what or who to trust.
You pay to get a polling result that advances your narrative, and hopefully it helps you win a marginal vote. That's what polls mean in the modern era. It's just a campaign tactic. That's my view anyway. So,
And so, in terms of the financial markets, you hinted at this could be very, very good for crypto. It's proven to be that in Bitcoin in the last couple of days. I think it's pretty obvious that Gensler, who's been other than Bitcoin, has been very difficult on Web3 and crypto initiatives, is not going to be around in a couple of more months. So that is going to likely, we don't know for sure how the dynamics of that are going to play out. What other parts of the financial markets do you think will get a short-term benefit, a longer-term benefit, and what may lag and be a challenge?
well, I think energy producers will get a benefit, right? So that'll include natural gas. You see, one of our picks in April this year was Shineri. Shineri is a leading liquid natural gas producer and exporter. They jumped on the Trump win. So that category, I think natural gas will do well. Offshore drilling, energy services firms, those could do well. Now, the interesting thing is you're going to get more supply output. And you're going to see more supply output because the US will have more output, and Saudi Arabia, which curtailed production, probably to try to influence the election, right? I think they'll start producing more. So you might actually see lower oil prices, which would be kind of an unusual side effect here. There's some interesting impacts to semiconductors, right? So Saudi Arabia wants to build 60 data centers, and they can't get Nvidia GPUs because the Department of Commerce is trying to influence Saudi Arabia policy. It may be related to oil, possibly, right? As you know, the Strategic Petroleum Reserve was drawn down to keep gasoline and oil prices low. So I expect that Saudi Arabia will get all the Nvidia chips they want without much export controls. So that's one. Two, there's an open question on what this means for China, right? So Nvidia's got to modify their form factor to deliver chips to China. And the Department of Commerce Secretary, Gina Raimondo, has given specifications on what Nvidia can export and not export. So that's an open question. Like, how does Trump deal with China and semiconductors more generally? If you recall, in October, Trump had a comment saying that, hey, like, I don't know that we need to defend Taiwan, number one. And number two, he said, look, Taiwan, something in effect of like stole the American semiconductor industry. By the way, I disagree with those policies. I think, semiconductors are strategic. Taiwan's a great trading partner. I also think the policy of strategic ambiguity makes no sense, but which both parties disagree with me on. But in any case, it's not clear where he's landing on semiconductors and China. It's not clear. So we need more clarity there. Tariffs are coming for EVs. That'll help Elon Musk. We know that's going to happen. I think you're going to see tariffs on China exports of solar. China is the most efficient producer of solar globally. They have a distinct competitive advantage that I don't see any way of being matched. So that'll benefit U.S. producers. I own First Solar, bought that recently, for example. I think they will be a beneficiary of this. CHIPS Act, we have some question marks there. Will CHIPS Act be scuttled? Trump is critical of that. Personally, I think it's a bondongle and a form of corporate welfare, and there's no need for it. Intel doesn't need billions of dollars. Like, let free markets determine what happens to Intel and its assets if Qualcomm buys them, or if GFS does a merger with them. So that's an open question. We'll probably see tariffs around auto, right? So hopefully this is used as a negotiation tactic to open up international markets so that firms like GM and Ford and Tesla can compete abroad. But we shall see. One very clear beneficiary and winner here are the banks. And I've been very vocal about this, but the banks will benefit from lower capital rules and regulation. So, think about where the banks have come from the '08 crisis with Dodd-Frank and stiffer and tighter capital rules and regulation. I think you're going to see lower regulatory capital requirements, which will improve the ROE for banks. You'll get a more favorable FDIC chair and head of the National Bank Regulator, the OCC. That's undoubtedly the case. The number one mover in markets the day after the Trump win was financials, up 6% as a category. So I think that's a no-brainer win here. So those are some quick thoughts. Healthcare, we'll see. I think there are different impacts depending on what subsector you're looking at, right? If you're a pharmaceutical company, you got a more favorable FDA if Vivek Ramaswamy is influencing that. By the way, pharmaceutical stocks are cheap. I bought Merck recently. It's got a 4P of like 10. So that's not my thesis, but it's more than that, but just trying to be quick here. So I think those are some initial impacts of who they've been. Now, the hard question is what happens around antitrust and big tech. Like I expect M&A will go up, right? You're going to have,
of course,
a new FTC leader, and that is also going to unlock capital markets, and more M&A and more IPOs are going to happen. You're going to see IPOs on the fintech side from Stripes. You're going to see IPOs on digital assets like Circle, for example, Chainalysis. So
right.
Capital markets are really. I'm already hearing about like SPACs coming back. By the way,
yep. I agree.
So I'll pause there. We can get into the antitrust section, but that's a quick summary of impact.
And audience, again, and Ram used the word earlier because they're trendy now. This is definitely going to be a long form podcast. I promise you, as an investor or family office, this will be probably the most intense, longer form investment discussion during this week that you're probably going to hear. So sit back and enjoy. I'm not saying every topic is going to be your cup of tea, but stay with it long enough. Something is going to touch upon what's going to be important for you. I'm an allocator and investor, represent single family offices as well. And I probably literally have 70 questions. We have a lot to cover. Okay, let's jump into it. Since you did bring it up, there has been thoughts that some of the powers that be within the newer Republican Party, Silicon Valley, some would say David Sachs, Peter Thiel, I could argue, although he's Austin, Elon Musk, that they're not too happy with big tech. Probably Trump is not overly happy with a perceived bias with big tech. There's a perspective that companies may be worth more collectively or individually the parts than they are collectively as one. And henceforth, we may see a rise of startups, of venture capital exploding again. It's been dead for a long time. I gave you a lot to chew on there. How do you think it could play out relative to big tech, antitrust, and the rise again and returns one day coming back of venture capital?
Let's work in reverse order there. I would say venture capital is overrated as an asset class. The DPI isn't there that LPs are looking for, so they're re-upping less and less. You're seeing increasing number of VC firms shut down, and over the last 10 years, QQQ has beaten the venture capital indices. And by the way, those venture capital indices are biased because they look at, say, the top quartile return. You don't do that with,
yep.
Right. I mean, it doesn't make any sense. If you look at the median venture capital investment, it's probably negative expected value, actually. So, and obviously, you're not measuring all the angel investments that are, most of which go to zero. So, I think venture capital as an asset class is highly overrated, and I think it needs a necessary culling, and it's going through a multi-year journey. There are plays in venture, such as secondary opportunities, where you've got a clean line of sight to liquidity, and you can buy things at a discount to NAV for maybe an LP that needs to sell. That's a forced sell. Interesting plays there. That said, the reopening of public markets, you'll get some deals done, and that'll re-liquefy those VCs. But the bigger VCs will get bigger, right? The Sequoias of the world will get bigger because they're in those deals that will go public. I don't think the world needs more VCs. Now, VCs have a very antagonistic relationship with big tech. Right?
Yes.
Amazon and Google are very good at squashing startup competitors, right? Amazon, by the way, I own both these stocks too. I'm just trying to call a spade a spade. I love them because they're monopoly businesses. And they're very effective at what they do. They're very effective at competing, using legal processes or using their competitive advantage, right? So Yeah, you raise a great point, right? Like what happens around, say, like a Google? I expect that on balance, most of these antitrust pressures will lessen, if not go away. It's a general rule. Now, the question is, will there be specific targeting of firms? Will there be kind of like a retribution to a Google for, being more progressive, let's say? Or, you might have seen the news reports on the night of the election where if you went to Google and say, how do I vote for Harris? You got like a walk map to the local booth. But if you said, how do I vote for Trump? You didn't get that. You got something more generic, right? So is there going to be any of that? I don't know. Now, interestingly enough, like the big tech firms know all this. They're very sensitive to this, right? The day after the McDonald's video where Trump was serving, French fries went viral, the CEO of Google called Donald Trump to congratulate him on that, and Trump mentioned that on the Joe Rogan show. Maybe it was an effective form of flattery. I don't know, right? But so they have these sensitivities, and they're kind of aware of these things. You also have to consider, what does the rule of law allow, right? So, I think overall Google will win on appeal as it relates to breaking up Google. So I think rule of law prevails, but it can create significant management distraction when you have to deal with all this.
Of course. And I would not be a fan in any way of Trump wasting his time being vindictive, which he probably does have a little bit of a earned reputation for. There's so much more, for pardon a little bit of the pun, but bigger fish to fry here, that I think they should get a little shout out verbally, a little scolding, but I don't think you want to waste time and necessarily take that too far.
Let's double click on this topic. Let's double click here. So it's a very pregnant topic. By the way, Zuck too. I remember after the attempted assassination attempt in July, Zuck had a video, also went viral, and he said that was badass, right? So now those are Meta's an incredibly large social media platform. What about Jeff Bezos? Now remember, he owns the Washington Post. They were going to endorse Harris, and he came in over the top and pulled that. So you've got Meta.
Is that really how they feel, or they're covering their ass?
No, I think taking Bezos at his word, and I think is fair and legitimate. What he said in that op-ed is that essentially to the effect of acknowledging the shift to social media, and that these traditional media outlets are not in tune with the broader population, and that's hurting their credibility. So I don't think Bezos is running for office. I think you can take what he has to say at face value. I don't think he's posturing here. I think Google and Zuck are playing. They have to do what they have to do. I think that's a bit different there. But so yeah, like big tech is trying to adjust and adapt. Now there's an interesting question around, well, what do you do, right? So we'll see how the House shakes out. But if you control all chambers, what is the social media regulation or lack thereof look like, right? Because algorithms have influence and power, no question. And there's no question in my mind that Joe Rogan, that interview, and Elon Musk influenced in a beneficial way the outcome for Trump, right? Now, if that's the case, it really raises really interesting questions around a platform like Twitter, right? Twitter is the public square. Okay, it's a privately owned public square. Now, what do we care who the owner of that public square? I'm still thinking this out loud, but I think it's a fascinating topic to dig into and try to unpack, right? So if you're Team Blue, you were happy with the prior owners of Twitter. If you're Team Red, you're happy with the current owners of Twitter, right? Now, what's right for America is a different question. Because if you have a public square, it shouldn't really matter is my instinct on who owns it. There should at least be transparency into the algorithms for sure, right? And the second question would be, did Elon Musk influence the election in the opposite way in which he criticized the prior owners of Twitter? I'd love to know, right? I'd love to know. Now, he's a private owner, and private owners can do what they want with private assets. I'm not making that kind of claim. I think one, I'd love to learn. The other point he made is, if you recall, like this past weekend, he was on the Joe Rogan show again. He said, look, if this election goes the other way, Team Blue, this will be the last election. I think that's hyperbole, by the way. Every election, someone says something like that. This is the most important election. I think that's hyperbole. However, if he believed that, if Elon's mental mindset is, if this election goes the other way, then that's the end of democracy, right? Both sides had an end democracy argument, of course, right? Then wouldn't it be in his rational interest to put his thumb on the scale and try to influence and shape an outcome? Now, how do we feel about that as Americans? Now, one answer might be, well, it's okay because like my guy's in power. Or, truth for me, not for thee, right? That's like a might is right argument. I think we don't know how to deal with social media. We just don't know how to deal with social media. We don't know how to deal with central banking too. These are the big puzzles.
Very big puzzles. You mentioned before, it's one of the 3 things I probably hear the most hate about. There's like 20 things, but it probably makes the top 3. I know it's very niche, and I know I love Silicon Valley. I still love to go there. I think it's awesome. But VC has been overrated for a number of years. Part of it is supporting entrepreneurs and the cycle of belief and faith that we have here in the US as I travel the world that is incredibly unique and awesome. So as an ultra high net worth investor or family office, I want to support the American ethos. I want to support the ecosystem. And over time, if I get 12, 15, 17%, that's great. There's going to be losers in the portfolio and winners. And by the way, exactly what you said, here's what a multi-billion-dollar family office told me. It's not the perfect alignment, but I'm going to invest in the triple Q, go to sleep for 10 years, and I'm liquid, net of fees and taxes. I'm probably going to dominate what I would have had as a return in tied up venture capital. It is just the reality. Is that a guarantee that's going to be that way moving forward? Of course not. But if I go by the last couple of years and look at it overall in the big picture, that is 100% true. I had an other family office from the other perspective, Angelo, but in your backyard, he of course passed away, but David Swenson of Yale, a third plus of capital and venture capital. And I'm like, dude, that might have been incredible in the 80s and 90s and even early 2000s. Has that really been so good for much of the past 10 years? You're reading a book and hearing thoughts of something that was decades ago. The world has changed over and is so different now in the last 5 years, let alone 20, 30 years ago. So I don't mean to bring up the VC, triple Q, and that whole argument, entrepreneurship, but it obviously struck a little bit of a chord with me, with my audience, whether they like it or not. Mm-hmm. And I'll give you a chance to expound upon what you said now that you heard my commentary.
Yeah, no, I think I like the logic of the family office. Two quick comments. One is capital is rewarded when capital is scarce. So the best vintage venture capital, like 2011, so around when Uber was birthed, for example, you're getting like a 4 million pre-money valuation and first money in. Now that number is like 10 million, 16 million, 20 million. If you put AI or .ai or .io, then it's 30, 40, or 50 million. Okay. So you make your money on the buy. Your entry valuation is it's the number one driver of your outcome. So that's one. The second thing why I think venture is a very risky category today is because the velocity of change we're going to see in the next 5 to 10 years due to the rise of AI is extraordinary. And this cycle, you're seeing tech eat tech. You're seeing tech on tech violence. You're seeing AI startups disrupt SaaS companies. And SaaS companies in the 21
Yes.
cycle were all the rage. That was supposed to be the theoretical optimal business model of recurring revenue, low capex, predictable cash flows. Now AI is putting that category at risk. You have Mark Benioff, the CEO of CRM, trying to pivot towards AI. I think that business is at risk, not imminently, but that business is at risk.
100%.
Now, he's trying to fire offense towards Microsoft. He's saying Microsoft's behind the time, right? Now, I think they're all at risk. They're all at risk. And this is going to be a feast or famine market. You're going to have incredibly outsized winners with like a power law like outcome. Number one, you're going to have a lot of losers, even sharper split.
Wow.
Significant number of losers. You're going to have AI immune categories that do just fine. For example, land, real estate, and insurance companies, and healthcare, and banks. Right? Those businesses are going to do just fine. I don't know how you disrupt this with AI. They're tech-enabled businesses, and insurers that can underwrite better with AI. They've already been doing that. It's called machine learning, by the way, right? But maybe you can reduce your servicing costs with AI. I think wealth management will be disrupted. That's my goal. My goal is to disrupt wealth management, right? How do you rethink servicing, investing, and marketing with AI? So you'll have this feast or famine dynamic. You'll have more winner take all kind of outcomes. So if you think about the rise of AI, or maybe AGI in 4 or 5 years, is what folks are saying. I think that sounds about right. If AGI is truly the singularity, right? Singularity evokes this concept of the center of a black hole. We have infinite density. You have low volume and a large amount of mass. And the idea behind this event horizon is you can't make predictions inside the event horizon. The laws of physics break down. That's where this term singularity came from, why they attached it to AGI. They're saying, hey, gee, as soon as AGI is created, you got the super intelligence. I know some of this stuff sounds like it's coming out of science fiction, but let's play it out, right? But as soon as it happens, well, how do you make predictions about the world? How do you make predictions when you've got an agent that has super intelligence and access to resources? So now if you're a VC, how do you do that? The job of the VC is to futurecast and make a view, to have a thesis about the future. And VCs aren't investing in boring categories that are immune from AI risk, like HVAC rollups or whatever, right? Or what Brad Jacobs is doing.
Hey, that's in my wheelhouse.
Right. Or what Brad Jacobs is doing with building supply materials rollups, right? AI is not going to just. So how do you as a VC make those kind of forecasts? Now, look, I think there's still bets to make. I still think I'm an investor in certain VC funds. Like, I think there's still areas and opportunities. So I don't want to tar the whole category, but on average, as an asset class, I think it's not a good move to make, and to tie up that liquidity. I don't think it's a great idea. They're not compelling bargains when you look around. I'd rather own an asset where I've got a site to liquidity. I can underwrite it. Like I did the CoreWeave deal. I have a path to liquidity next year. You and I talked about that previously. That's done 3x in the last 12 months. We got long-term capital gains.
And Rami, I'm going to interrupt you because it's an important note relative to that. Yeah. By the way, I had a private family office gathering for Ram on that opportunity. My audience knows I'm extremely active in AI, and that is probably the number one thing. I mentioned number 3 before, VC. The number one thing I get negative feedback on, well, again, it's many things. Angelo, you're a family office guy. What do you know about AI? Well, I don't know. I interviewed Ray Kurzweil. I go to Silicon Valley all the time. I'm invested in public and private markets. I'm normally pretty good at seeing around corners. I'll dare to say I'm almost always right. My timeline, sometimes that has a little bit of a spotty record. We're going to talk more about AI and AI companies shortly, but now you bring up another point that popped in my mind, and we're going to offend some family offices here. This is potentially a principal and agent problem. You don't know what you don't know. Mm-hmm. You're playing it safe. You want to get your 6 to 9%. Don't rock the boat. Rule number 1, don't lose money. Rule number 2, Buffett, remember rule number 1. That sounds good in theory. That is not always good long term. The bigger point I'm getting to is so few families had any interest in that deal. Nothing is guaranteed. Taiwan gets invaded. Lots of things could go wrong. But that is almost a no-brainer to consider, form a thesis, and likely move forward on. Yet probably under 1% of people that I reached out to even gave it a little bit of a hard look. Like,
It's really
do
funny.
family, so the big picture, Rom, that's going to get us both in trouble. Do family offices know a good deal when they see one?
No. Family offices, on average, are terrible, terrible investors. I mean, you know this. I know this. Some of them are phenomenal. Again, those are people that, we try to trade ideas with. And that's how we got access to the Brad Jacobs QXO deal. QXO hit new highs. Today, we got into the $9.14 price alongside, Duke University and the Kushner family and the Walton family. You and I also talked about that. And I remember we were on calls with, folks in your network, and no one in that group signed up. It's really funny. Our clients did, and now they're up, I don't know, like 70% with no lockup and liquidity. And we're essentially out of that deal now. It's realized, real returns, right. Cash in the bank. But, investing is hard, number one. And if you don't recognize that, you won't be a good investor. I think family offices recognize that, but they don't know how to proceed forward. Because if you want to be a good investor, you need to have domain knowledge. You need to be able to learn quickly. You need to have an excellent network, and you have to be able to access opportunities, and you got to be able to recognize a good opportunity when you see it. Because there's so many opportunities in the world, most of which you have to say no to. But now and then you get a yes. CoreWeave was one. Brad Jacobs QXO is another. When I talked to our clients about CoreWeave last year, by the way, they're like, what about OpenAI? I was like, we're talking about OpenAI. So OpenAI is spending billions of dollars on CoreWeave, and it's expensive. And they were going to lose money this year without the fact that they had to do a raise with the Kushners set a price. And that doesn't mean it won't do a 2x or 3x, but it's more in the category of speculation because it's not profitable. And they have dependency on their parent Microsoft. And they've got competition on all sides, from Meta at the app layer, from Google on the other side, from Anthropic at Amazon, search engine wars. Whereas with CoreWeave, you've got a dominant market leader who's profitable, who's got a forward PE less than the S&P 500, where 90% of next year's revenue is committed.
I know,
coming from big tech companies and governments, but they don't invest. Family offices need to be told by Goldman Sachs that you're supposed to invest in this. The Goldman Sachs can't get in that deal either because it's too small, it's niche, it's capacity constrained, which is the marker of alpha.
You know that I completely concur. And to some degree, that does make me, even though I've been in this community for 20 years, traveled the world, know thousands of family offices, put more content that's original and proprietary, including this interview, together by far than any other family office, specifically single family office person in the world. Of course, I get called arrogant for that. That's just a reality of it. And by the way, I am wrong my fair share. I am not saying otherwise. But to assume that just because of that, talking the truth gets hate, and I'm an extreme advocate. I'm obsessed with being an advocate that the right single family office, even for a family well below $500 million, in my opinion, the right family office, people, systems, and technology is always the best choice. So single family offices, you don't have a greater advocate than me in the world. Yet, so many of you make this grand mistake that Rom highlighted, that I highlight, and we get hate because of it. Okay.
There's a central paradox. There's a central paradox of investing, which is that the best ideas are non-consensus. So if you pitch someone a non-consensus idea, they say, that's crazy. Why would I want to invest in that? And if you pitch a consensus idea, then it doesn't perform, right? If you look at the US 1 list at Bank of America Merrill, that's their 10 high conviction stocks. Over the last 10 years, it's lagged the S&P 500. In year end of last year, one of my stock picks was Build-A-Bear. You can't ever imagine Goldman Sachs saying, go buy Build-A-Bear. That would never happen. You'd get shot in the investment committee because it doesn't feel right. And it's outperforming most of the stocks in Mag 7 except Nvidia. It's beating Meta, Google, Apple, Tesla, you name it. So that's like a core weave too, right? So people like familiarity. People like ideas that already are socially proof, which means it's already fully priced. It's already fully valued.
Mhm.
A non-consensus idea, by definition, can't get through consensus committees. Committees are the enemy of returns. So what a family office will do is they'll call up their friends. What do you think about this deal, that deal? And they'll say, "Oh, we don't like it." I do the same thing, by the way. We all have networks of investors we bounce ideas off of. So I invested in an insurance company. I called up 3 very smart investors, private equity, da da da. They're like, "I hate this idea. I hate this. Okay, this is great. I'm buying this thing now. It's all priced in." It's a different way of approaching investing. So most family offices just buy the S&P 500, call it a day. Stick to consensus. Recognize that unless you're going to do the work or trust someone, that is non-consensus, which is what you need if you want outperformance.
And some of the irony that you mentioned, the triple Q, the S&P long term, it's actually probably pretty good.
They're the best businesses in the world.
But most of you don't even do that. Oh, I need to be involved. The consultant recommends this big hedge fund. I'm buying Big Blue. You're going to underperform most of the time. Yeah. The S&P and the triple Q.
The hedge funds are awful. They're terrible. Like Bill Ackman, I don't know, he's up 6% year to
I
date.
got to be able to walk around Greenwich, Rom, so be a little careful.
Oh
here.
my God! Look, some of them, again, there's always exceptions here and there.
Of course, yes.
But by and large, the brands that you and I know, Dan Loeb is terribly underperformed. Bill Ackman's terribly underperformed. David Tepper, it was offsides on China. Did he hold on to this thing after the problem?
So they are too big. They placate to institutions, and the good ideas on smaller companies, they have too much capital, and relative Ackman's a little different because he's very concentrated. It's hard for them to move the needle on a little more esoteric ideas.
Yes. And they can't market their fund to the LPs if they have esoteric ideas because the LP has to know the names. Now, the thing about S&P and the QQQ, like I own Nvidia, Meta, Amazon. I like those names. Meta, Nvidia, Amazon, Google within Mag 7. I don't like Tesla, Apple now. And those 4 are the best year to date, by the way. And I've been consistent about those names. I added Amazon to the fold in the last 3 months. And you and I have talked about those names before. Mm-hmm. So I'm on the record around that. We got that call right. But those are world-class businesses. They have dominant monopolies. Like I want to own them, even though they represent something like 25% of the weight S&P. And I'm trying to separate the wheat from the chaff, right? I'm trying to not get laggards in there, so I don't own those other mag names. But the point is, nothing wrong with owning the S&P and the QQQ. Like the quality of these indices is much higher than what they were 10 years. I think Build-A-Bear was in the S&P 10 years ago. It's not now.
100%.
Build-A-Bear shouldn't be in the S&P, by the way, even though I own it. So the S&P, like the quality of these businesses is very, like the quality of business like Caterpillar or John Deere. These are very high quality businesses. They've got a dominant market position. They've got good unit economics. They've got a good moat. They've got a good brand. They're not going to go away in the next 50 years. They have good quality customers. Yeah, nothing wrong with the S&P 500, or the QQQ.
And a couple of comments there. One, and this is a long form interview. In about probably half an hour, I'm actually going to name a series of stocks and get a little bit of my perspective, what I'm invested in, and get Rom's feedback, good or bad. So we got a lot of content. Wrapping up the area of family offices making decisions, I have an Angeloism that, again, a lot of people don't like. Bad family offices want to be left alone. Good family offices want to be mentored. Great family offices, which, by the way, is about 3%. I admit some of that is qualitative. I hear you. They want to be told the truth. The truth. Let that sink in a little bit. And again, bring on the hate. I'm fine with it. Rom really set me up there with some of his comments about non-consensus investing, and I'm going to give a little infomercial here. I am going to invite Rom to this, and hopefully he'll be one of my featured in-person speakers. It's going to be April in New York in 2025. I'm going to put together, I already have the framework all built out, a 10X investment summit. It's going to be one day, and it's going to be an opportunity to hear incredible ideas by incredibly talented people and really looking for their best exponential growth opportunities. And here's the kicker: 90% of it is probably going to be public companies, things that right there you could go on your phone and make a decision on and invest in. There's no financial tie-in to me. I get a piece of nothing. Most of what we're talking about is strictly going to be public. Some of those companies, I'll throw one out there now, Sweet Green has had an incredible year so far. Now, the irony of 10X and a little bit of my wink, wink, I'm not giving you a timeline, but I think you get the idea. These are likely going to be heavy overperformers. So stay tuned. It's going to be April, and people like Ram, I'm going to invite. We'll make sure we find a date that works for him. Luckily, it's in New York, so that should be easy. It is going to be an incredible day. Stay tuned. Within probably 2 or 3 weeks, I'm going to have more promotions, and we're going to have cap that at 100 attendees. So simply stay tuned. I'm going to go back to what I think goes back to our earlier discussion. Trust me, we have much, much more coming up about investing. But I think it's a little bit of an 800-pound gorilla relative to whether it was Harris or Trump. To me, it doesn't matter. And that is going to be a $36 trillion deficit. All these candidates, I'm not going to taxes on tips, Trump is saying. We're going to do tariffs. We're going to do this. We're going to do that. And we're going to lower interest rates. Inflation's going to all come down. To do all of that, to have the opportunity, I want you to tell me where I'm wrong. How are we going to address, are we going to keep on kicking the can on a $36 trillion deficit that grows by trillions and trillions every year? And now we have the rise of AI, which may be a partial solution, but also may cause greater unemployment for especially about 5 to 10 years out. How are we going to address without pain? And a politician can't sell pain. But I think we may need pain more than just Elon going in and cleaning up $1 trillion or $2 here or there, which, by the way, the deep state is going to fight that tooth and nail. You're letting go of American employees employed millions and millions by the government. That's good. Good luck if he can make a dent in that. I think he'll make a dent. I don't think he's going to make a major impact in it.
Okay. I don't know. We'll see what he does. Sounds like he's following through on. So, wow, what a great topic. Look, the way to open this up is there's this wonderful quote by Osho, who's a philosopher. He said,
yes, he's a legend.
He's a legend. Remember this quote? He says, democracy is by the people, for the people, but the people are retarded. Okay? So democracies will keep spending money. Look, if you want to get elected, you can't take away their benefits. The number one driver of fiscal spending is entitlement spending. That means Social Security, Medicare, Medicaid. No one's campaigning to cut those expenses. It's not defense spending. It's not Department of Education, not Department of Energy. It's just entitlement spending. That is the single most significant driver of the American deficit. It's not going to go away. Now, what could cause it to be addressed is a dislocation in the bond market, right? So after the Fed cut rates 50 bips, the 10-year started blowing out and mortgage rates started blowing out, and Druckenmiller shorting bonds. So if the U.S. is a failed treasury auction, that I think is an event like that would cause focus on this issue. Absent that focus, the natural tendency of Congress and both parties is to spend. There's no accountability mechanism except for the debt capital markets. You need to see a breakdown in that market. By the way, here's the other thing that might happen. Supposing that were to happen, supposing that there was a failed treasury auction, and suppose credit markets freeze like they did in March 2020 during COVID, would we not potentially see the Federal Reserve reintroduce quantitative easing, the purchasing of mortgage-backed securities and treasuries? Right? Mortgage rates now are above 7%. They're starting to come in now. I think we've seen the peak in that. in the last 2 weeks or so. So, and if that's the case, then that would lead to more of an inflation kind of outcome. That'd be like modern monetary theory is back. So I don't have confidence in Congress. This is a flaw with our framework. It's a flaw with, this is the one flaw in the framework for our governance. Like the tendency to spend. Productivity growth could be a bailout. Right? If AI can come online fast enough,
Yes.
we all seen elevated productivity growth. We haven't seen the kind of productivity rates we've seen now since the late 90s, and that's very bullish. So that's a possibility. But where the economy needs the most help is on the care for the elderly due to the grain demographic pyramid. There's this inversion of the demographic pyramid. The US is in a better position than Europe and Japan. So we get to see how those guys go over the demographic cliff, so to speak, in China, right? The answer is automation, robotics, right? But you need care for the elderly and you need care for the young. And robots and humanoids and AI can't address that. I'm not in the mass unemployment camp. I think markets work. Like when Easy Pass was rolled out, the human servicing the toll booths, those jobs went away, but other jobs were created. Real incomes have gone higher since then. So, you'll have AI can do training. So dislocation gets addressed. AI needs human beings to do things. I'm trying to disrupt myself with the AI I'm building at Lumina. So it does more and more investing, just as Ram, go buy and sell this, right? I will then start, hopefully in 5 years, my daily tasks are limited because ultimately humans have to own decisions. Humans still have to own decisions legally. We are legal persons. Unless you incorporate an entity.
We are going to get to that, Ram.
Okay, cool.
Everything is on the table for now today's 4-hour podcast.
Right.
Okay, I'm going to follow up a little bit on that with something that I read. I wish I was creative to think of this, so it's not me. I think parts of it are maybe true and interesting. Parts of it may be a little tongue-in-cheek, and it relates to the deficit Trump and the issue that you just went into. And here it goes. According to this person, I'm sorry, I don't know who they were. My bad. Trump wins. Federal income tax is eliminated. U.S. Strategic Reserve holds 1 million Bitcoin by 2028. Bitcoin then reaches 2.5 million. We're not done yet, Ram. CPI stays below 2% due to energy abundance and technology deflation. Wink, wink, America wins. A new era of prosperity begins. That, I think, was said with some tongue-in-cheek, but are there grains of truth to that? And how could that play out to be positive for the U.S.?
Income taxes aren't going to go away. That'd be nice. It's just not going to happen. Tariffs can't replace income taxes. So I just don't see that.
They may not need to, Ram.
Yeah.
Depending on what Elon could do with cleaning up waste, depending on what tariffs and other sales tax strategies could employ, and maybe that Bitcoin idea that I would have laughed at even a couple of months ago, is it really that crazy?
Let's go through each one of those. So once a tax is introduced, it's never, ever gone away. That's the lesson from Milton Friedman. He's been right. Is an income tax.
1913 or 1914? Yes, correct.
Consumption tax. If you get a value-added tax, that won't go away. You get a property
We're all
tax.
told it's temporary.
Right, exactly. Just like the Patriot Act was temporary too, right? Everything's a temporary, you add a tax, it just finds a way to justify itself and continues. So my concern was that we'll have a consumption tax. Now you have an income tax and a consumption tax. So I don't think you can get rid of income taxes anytime soon. So the Bitcoin, it'll be really interesting to see what Trump does with digital assets. I don't think Trump intellectually was truly bought into digital assets based on what he said at the Bitcoin conference. And
I agree with you.
I don't think he really, and if you look at the performance of the tokens he launched, they didn't go anywhere. Meaning the community wasn't bought into it. However, I do think that Trump will seek more favorable policy. Undoubtedly, you'll have a more constructive SEC chair, you have more constructive head of the OCC, and head of the FDIC. No question, right? Now, will Congress take an act to, one, pass stablecoin policy that's rational? Absolutely. That's on the table. Should have already been passed. That'll happen no matter what. That'll be move number one. I think that gets done sometime next year. Now, will they go beyond that and have a strategic reserve, this and that? We'll see. Like, I think it's too premature to even kind of discuss that. The transition team isn't even, they're still trying to figure out prioritizing team personnel, agenda setting, all the rest. So, but the other part is that, the U.S. government wouldn't reflexively buy an asset regardless of the price. It's not like they're a force committed buyer at any price. The same way when they look at the Strategic Petroleum Reserve, they're only now starting to refill that. Now, part of that's political, part of that because the price of oil is very low. So they were sellers at a high price, and they're going to be buyers at a low price. So we'll see. We'll see how things evolve. We got to see what appointments Trump makes to get clarity on his approach there. It is quite interesting, this idea of like, hey, the miners need to be in the United States. And it is quite interesting when you think about internationally, Russia and China do want an alternative currency regime to the US dollar. And
apparently,
I mean, they've all tried to do this.
Maybe backed partially by commodity. We'll see.
Right. It's hard to go in that direction because oil settles in US dollars and the US largest energy producer. And to have an alternative currency, you need trading partners that have matching wants and needs, right? Saudi Arabia needs F-16s from the United States. So we're a natural trading partner. And we need oil from Saudi Arabia, for example, natural. The United States natural trading partners, almost everyone in the world. It's kind of incredible. But most of those partners, like Russia and China are natural oil partners. Russia can export oil, let's say. Russia's importing like artillery and other kinds of things, semiconductors from China, right? So you need that natural alignment. But could you get a cryptocurrency to be an alternative settlement layer that has international consensus? That's a really interesting idea. I don't think it's a BRIC currency. I don't think the U.S. would choose to adopt that. It's a novel idea. Now, it's more likely to be a type of stable coin because people need to make price forecasts that are predictable to engage in long-run contracts, right? So, but you are seeing different kind of you're seeing a proliferation of stable coins, by the way. Now, currency-backed stable coins, obviously the most significant one with the most market share in the world is Tether. There's USDC. But you have other stable coins that are emerging, including stable coins like linked to like Bitcoin, for example, which is kind of interesting way to think about it. So I don't know. I think these are topics that are still in the distance and it's too early to establish a view. They are now questions that come into the foreground, though. They're no longer things you can entirely dismiss. I mean, you've got sovereigns that want to wean off of the US dollar because they saw the impact of U.S. sanctions after Russia-Ukraine war, right? They said, gee, we don't want to be influenced by sanctions. So how do we find an alternative mechanism? Now, but if the U.S. has a policy putting Bitcoin miners in the U.S., which is what Trump says, that would undermine international adoption, right? So that's, that kind of runs against that. And as you know, Angelo, central banks around the world have been accumulating gold like China. And maybe it's a stable coin backed by gold. We'll have to see. There's a lot of different trajectories it can take. The good news is governments are slow. They talk about what they're doing. They have write-ups. They have commissions. They get together. They make these pronouncements, and then you can see what they're doing and then adjust.
Oh, that leaves so much. And the comment that I made did include energy abundance. Why don't we save the nuclear and maybe a fusion conversation to a little bit further in our discussion today? But I have to still keep you a little bit on that hook, though, Ram. That comment I said did state something like 2.5 million per Bitcoin. Now, again, what did I say earlier about 10x? Sure, but give me a timeline. Within What would need to happen? I'm almost afraid to ask, Ram. What would need to happen within 5 to 7 years for Bitcoin to potentially be $2.5 million, quote unquote, a coin?
The set of circumstances to achieve that would be something out of a movie like Mad Max.
Yes.
Maybe,
Okay.
maybe not that. Even in a Mad Max scenario, if you don't have access to payment wallets, things could get very rough. I got to chew on that. I would say I'm not a big fan of like these 10-year forecasts. And I think you got to turn the cards as they come. I think you have to get new information and assess and reassess. There's nothing inexorable about the price of an asset. There's no destiny written into an asset. And
100%.
at the very least, you would need significant dollar debasement, of course, to have that world play out. And look, if you have a productivity story, maybe that doesn't happen. The bond vigilantes show up, then interest rates go up. If interest rates go up, then asset prices drop, including, I would say, Bitcoin in that scenario too. So it's, I don't know. I think you would need sovereign adoption. You would need central banks around the world accumulating Bitcoin to get to that case. And again, how does that happen if Bitcoin mining centralized the United States? Because that means the United States might have a shot on goal to censor transactions or do 51% attack. The other kinds of things that open up, which I don't see a setup for that given where we are today, right? I just don't see that currently. There are a lot of open questions. Well, why do you need to have a view like that anyway? Why not just play the hand in front of you, give the information you have to make a good decision where the odds on your side versus speculate? I put that in the realm of speculation.
How do you, a guest who's a pretty well-known figurehead now, I had him on several times, but it's been about 2 years, Raul Paul of Real Vision. I heard him on a significant podcast yesterday restate what I remember him saying 2 years ago, that he was, to me, like Angelo, 100% of my liquid net worth. I don't have the guts for that. We're going to talk about high conviction, concentrated ideas shortly, but he basically said 100% was effectively in Ethereum. He said he looks at it as a $2 trillion market cap that's going to grow to 100 trillion, but he's been saying that for a couple of years. And again, a long enough time frame, sure, but how long? Broadly speaking, besides that stark comment, do most investors and family offices have, he may be extreme one way, but are most of them maybe significantly underallocated, even if it means boring? Bitcoin, Ethereum, Solana, a third, 3 to 4%, maybe 5%. Go to sleep, call it a day. What do you think?
Well, I'd say the right time to have asked this question was last year, and the answer would have been yes. And obviously, they will allocate right at the market top. That's what they'll do. And they'll allocate because it'll become a consensus at that point in time. Well, I should clarify what I'm saying. They will allocate. We are at actually near highs now. We are at the highs right now for Bitcoin, not for Ethereum. For Solana, we are, right? So, they'll allocate when it's consensus to allocate, and that'll be the end of the cycle probably. So, you got to allocate when it's non-consensus. Last year, in the wake of the FTX collapse, in the wake of Genesis collapsing, that was the low for digital assets. This is why the DNC, they made a wrong bet. Politicians are terrible investors, right? Clearly.
Kind of like economists.
Right. They took in money. Elizabeth Warren took money from SBF, right? Their family, friends, etc. SBF's parents and Warren, and they had to run away in the opposite direction. And they decided to essentially go after the digital asset industry, and it backfired in an incredible way. Think about the digital asset candidates that won elections versus those that did not. Significant skew. This goes back to public choice theory of Gordon Tullock, who won a Nobel Prize. If you have a vocal minority that's highly motivated and concentrated, they will get outsized results. And that's exactly what played out here, right? So I think for family offices, you got to start with, what's the investment policy statement? What's the time horizon, risk return, liquidity requirements? Do all this, Got to look at what other exposures they have, what are they trying to solve for, and then work out what the appropriate allocation should look like, right? It makes sense for some, not for others. Look, I'll tell you, I had another nanny. We got a couple nannies part-time doing different roles. Another nanny, she asked me for financial advice, and I went through the numbers, helping her out. And she's like, should I buy these tokens? Like, no, it's not for you. You should not do this. No. Like, my framework is this. You have 3 buckets. One is safety. The second is lifestyle. And the third is aspirational. Solve for safety. Make sure you've got a liquidity buffer so that if your tire pops out, you can repair it and go to work so you can continue to stay gainfully employed. Get that liquidity buffer to address emergencies and issues. Solve for safety, number one. After that, think about it as a bucket you fill up with capital, and the riskiness that capital is attached to corresponds to the nature of what you're trying to accomplish. So that safety should be really boring stuff that we don't even want to own or talk about, like, right? Fixed income securities, let's say. Okay. I'm not a big fan of treasuries, but theoretically you're supposed to put it in that kind of asset. The second bucket, lifestyle, you want to put in stocks that match the objectives you have over a similar kind of horizon. You're saving for college tuition for your kids, you're saving for retirement. It's a 10-year time frame. Stocks will do great in 10 years. Okay. Then after you solve for buckets 1 and 2, solve for those goals, then you say, okay, I can achieve my planning objectives, my retirement, my investment objectives. What do I have left? Now you have this bucket of risk capital. And then you say, okay, how do I want to consider deploying this? By the way, the wrong move to make is take that risk capital and make a lot of risky bets, because risky bets on average don't actually work out. It's a funny thing. It's actually, this is the genius of Warren Buffett. What he does is he says, oh, I'll just do a carry trade. I'll borrow in Japanese yen at lower than the cost of inflation. I'll make sure I can't get a margin call. I'll make sure I'm using permanent capital. And he'll just lever high risk adjusted return opportunities called quality compounders, businesses that generate free cash flow. Then he'll buy more businesses, get the depreciation benefit, or buy back his stock, or buy, right? So that's actually a very good answer for that third bucket, by the way. It's a very good answer. Now, but there might be other strategies you can take, like what you and I talked about, the CoreWeave deal, the Brad Jacobs deal, what we do with ASPI, or digital currencies. So that's my framework, how I think about allocation, asset allocation.
And we're actually going to come back to that because there's some deeper questions within that. But I did promise I would throw out some stock names, some names you already mentioned. Ron, we have a lot to cover, so maybe we'll keep the thesis analysis, maybe 2 or so minutes each. And then I'm going to come back to 7 or 8 other names a little bit later. But I'm going to start with several in the Mag 7. Why don't we start, because it actually did make the title, why don't we start, and Elon is right now at the front and center. We'll start with Tesla. Could I make the case with Optimus Robotics, with what is going on in robotaxi, that although you may not be the biggest advocate, that it's the best opportunity now? That what would be a good case moving forward, a bad case, and why do you feel the way you do?
So let's add to the screen, if you can share that, Angelo, my analytics tool here. So this is showing the year-to-date returns on Mag 7. And as I've said before, my preferred picks are Nvidia, Meta, Amazon, and Google. Tesla only recently actually kind of dislodged Google here. You can see the year-to-date returns on these names. Now, Tesla had a big move recently on the election, and people focus on big events like that, but they also lose perspective with that. If you actually zoom out and see actually what's working, Tesla hasn't gone anywhere in 3 years. And let me look at the 3-year chart of Tesla. Excuse all the lines. Tesla really hasn't gone. Tesla's still not at all-time highs. Okay. If you've been in Tesla, you've been on a roller coaster ride with dead money for a long time. I was interviewed by Yahoo Finance a few weeks ago, and they said, Ron, what's the catalyst for Tesla to go down, given your bear case that you got China EVs, you've got more competition from players like Figure coming, you got margin. And I said, there might not actually be a catalyst. It might not be a catalyst. Why? Because you got Q4, great seasonality, you got the Fed cutting rates into Goldilocks. So I don't like it, but that doesn't mean it can't go up. It is going up. It's going up today on a short squeeze. Tesla's a popular hedge fund short. I don't have a short on this today, by the way, but what's happening is you have a bunch of hedge funds that were caught wrong way positioned into the election. There were a bunch of people that got together in a committee 2 weeks ago. This is classic consensus investing. Some smart person with a CFA got up and said, hey, we should hedge out election risks. It'll be a competitive election. First of all, it wasn't competitive. It was a Trump popular vote win. And we should just go hedge. And now they're caught in a short squeeze, and they're caught in a performance chase, and the market gapped up on them overnight. And now they've got a bid. That's what's happening. Going into the election, we were long. I said you don't want to be hedged going into this election. So that's what's happening there. That's why Tesla's going up. It's not going up for a fundamental reason, right? It's not going up for fundamentals. Now, it'll go up arguably on a news flow around this China tariff. See how that plays out. But Tesla is more expensive than Nvidia. It's got 105 Ford PE ratio right now. So it's trading on vibes. Now, I'm an investor that looks at long-term trends, themes, valuation, earnings growth, quality man. I try to put it all together, and my framework won't allow me to own that name. It doesn't mean that it doesn't go up. In 2021, everything went up. This is the part of the market where everyone's going to feel like a genius, by the way. This is called a junk stock rally. It happens. This is the part of the cycle where you're going to get that. The Fed is cutting rates. When Donald Trump was elected, that's equivalent to 100 basis points in rate cuts. Animal spirits are coming out. The psychology is changing. The vibe session's over. It doesn't matter if the person you voted for won or lost. It doesn't matter, right? 100% of people were in a vibe session last week. Now 52% are no longer in a vibe session, and vibes are contagious. Psychology is crucial. There's a new event. People are more optimistic. People are reconciling to this new reality. And a certain portion of the population won't, but they were in a vibe session before. They still aren't it now. On the margin, though, you're going to get this animal spirits bid that's happening. But the key test will be in a bear market, which will happen. How does that asset do? It's not going to do well at all. The way you test a good investor is how do they do in a bear market? What's your through the cycle performance look like? This is the part of the cycle where it's easy to look like a genius on the way up. Everyone's going to feel like I'm getting tips from doctors now. It's a good contrarian indicator. Like, oh boy, it's that time of the season now. I'm getting stock tips.
And I'm going to mention two other companies. They're both in the Mag 7, where I'm going to lump them together a little bit as they do have something in common. More than something, but this is obvious. Nvidia and Meta. They have a founder who's the acting CEO that the vast majority of their net worth is tied into the company. Oh boy, do they have skin in the game. So what would be your thesis, for lack of a better word, on Nvidia and Meta?
Look, I love them both. They're overweights in our portfolio. That long-term secular thesis is intact for both. They're both indexed to the AI play. Nvidia is the lion's share winner in the AI thesis because they're capturing the bulk of the value creation around AI. I wrote a thesis called the Semiconductor CapEx Receiver Thesis. It's a mouthful. In November of 2023, right off the October lows. And one conclusion was you should own Nvidia. And obviously that's worked out well. But the fact is you've got governments and you've got the most cash flush corporations in the world, namely other Mag 7 players and cloud companies now, and corporate America and Accenture spending money on GPUs, and countries like Saudi Arabia and Japan. And China, right? So one of the key markers of a good business model is the quality of your customers. Do they have staying power? Do they have free cash flow? Is it strategic? Is it a top 3 priority? And the answer is yes, yes, and yes. So Nvidia's in good position. You got to be tactical around these names, though. My last Nvidia buy, which I wrote about on Twitter, was at 105 in mid-September. That was a great entry point. So look at the forward PE to get a sense of where this is. People always buy at the wrong time. So I'm just trying to help people with tactics, right? Buy low, sell high, right? So on Meta, I think Meta is underrated. I think Meta is an AI winner. It's only now starting to get pricing for AI.
Yes.
Only now. And you and I have talked about Meta and Nvidia before, over the last 2 years, and we've been consistent around these ideas, and they're working, right? Meta, they've got the distribution. They've got WhatsApp. They've got Facebook. They got billions of users, number one. That means also they have 2, data. You need data to win in AI. You need training data. Google has YouTube. Meta has all the content people upload. Number three, what Meta is doing, which people don't fully appreciate, is that Zuck has shots on goal. I'm not saying he'll get them. I'm not saying he'll get the goal, but he has shots on goal. And you've got to probability weight his odds. He has shots on goal of being the next form factor, meaning he's got this new headset, these smart sunglasses. Apple is now going in that direction, where you can interact with AI, you can interact with information in a fundamentally new way, where you don't need a mouse. Like the mouse was the old form factor since Xerox PARC. We don't need the mouse anymore. We don't need the keyboard anymore. You need audio in your ear. You need augmented reality through your eyes. That's a natural way you and I are communicating right now with our eyes and ears, hands-free. So if Zuck is correct on that bet, you're thinking of a new way for work, play, and living, where you don't need the Windows operating system even. So he has a shot on goal to displace Microsoft. We're talking trillions of dollars in value. And you'll notice that there's a news saying that Meta wants to build their own search capability. They're not trying to go against Google. It's not about that. It's how do you incorporate search into your AI experience? Because search is really about asking a question and getting an answer. So he's going after Microsoft. He's going after Amazon. They're testing e-commerce, right? We've seen the success of social media-driven e-commerce with PDD in China. PDD is gaining share from Alibaba. So Meta's going after that too. That's another big total addressable market. And Meta's cheaper than both Microsoft and Amazon on a 4 PE basis, by the way, significantly cheaper. He's going after Google on the search thing. I mean, Google, everyone's going after Google right now, right? So, and he's going after Apple. Like, do you really need a cell phone in the future? The incredible innovation of Steve Jobs with this Apple iPhone and reimagined how we think about communication, rethought the cell phone. Zuck is doing the same thing. Will you get it or not? I think it's the wrong question. I call it a real embedded option. If any of those bets pay off, it's not priced in. And Meta's got like 25-30% year-over-year revenue growth at scale. So, and they've got an incredible AI team in Jan LeCun. AI is starting to top out right now, by the way. They're seeing limits to growth on AI. They need new technology and engineering innovation. It's not a matter of training it on the Library of Congress or throwing more parameters at it by getting it more GPUs. Those are levers. Those are legitimate levers, and people will do those things. But you also need de novo engineering, right? The whole AI revolution was based on this paper called The Transformer, published at Google several years ago. You need new forms of AI engineering, and Jan LeCun is best positioned to do that.
Probably Ram, I'm going to say 2017 or 18, reached out to him, Jan LeCun, cordial enough to invite me to do a very brief 10, 15 minutes in person at a round table in New York, just me and him, but an executive conference room. Him and Elon are definitely getting into it politically on X. But there's no question that Jan is a deep intellectual, a very smart man. And whether I agree or disagree with him politically, and this is the whole problem now, we bifurcated so left and right, we are not respectful for other opinions. And the fact that there's incredibly smart and talented people on both sides that we could be open-minded and learn from. And hopefully there'll be some healing, although I'm a little bit skeptical.
Sorry, go ahead.
Oh, no, please, Ron.
Well, briefly, don't let your politics get in the way of a good investment. That's crucial. Crucial. It's crucial. And people do this all the time. People were selling Google in February because of the woke virus. I think DEI and the woke and the pronoun stuff needs to go away. Okay. That's my personal view. It doesn't mean that I'm not going to buy the cheapest stock in Mag 7 with earnings growth and dramatic free cash from a competitive advantage. I also think that Google and Apple are gatekeepers and they need competition. And I also believe Amazon engages in anti-competitive behavior. No question about it. And there are plenty of examples of startups who've had their models. It's like you talk to Steve Jobs, like, hey, look, I'm going to buy you at this price. Or if I don't, I'm going to compete with you. I mean, there's a lot of stories like this, obviously. And that's actually not such a bad, that's actually a story of competition. But there are other stories from Amazon where It's, you look at what products are selling the most on the third party site, and then you put an Amazon branded product and take that share using their data analytics and logistics. Right. So but I'm not going to let my views get in the way of making a good decision. Those are monopolies with significant competitive advantage. So why am I not going to own them if I can get a good entry?
My next question, a little out of the blue, goes back to what we maybe spoke about 45 minutes ago, relative around VC, relative around Silicon Valley, about entrepreneurship, about supporting entrepreneurs. I'm going to probably mess this up a little bit, but I read, and this was kind of startling to me, then I thought about it. Has every trillion-dollar company effectively started or is based in from the Bay Area through Seattle? Now, technically, Saudi Aramco, the paperwork and legal filings were in San Francisco. Admittingly, that's a little misleading, but technically accurate. Yes, of course, I know Zuck in Harvard on the East Coast, but basically they're deemed to be a Silicon Valley company, and Berkshire is a little bit below that. So for now, that comment could still be stated. Let's take that comment on the value of it. Wow. So one, every trillion-dollar company in the US, and two, all concentrated or originated in, now a little bit misleading with Saudi Aramco, I get it, in the Bay Area through Seattle. Why?
Well, I think the American entrepreneurial market and American venture capital and the know-how of how to build businesses, the ecosystem, the universities, the proximities of, say, Stanford and to Palo Alto, like perhaps the birth of venture capital and, Fairchild Semiconductor. I think all of that plays into it. Fundamentally, you can look at Americans we're a high trust society, right? If you're giving someone capital, you trust them to execute against a plan, number one. Number two, there's a culture of forgiveness. If you screw up, we're willing to forgive the entrepreneur, maybe back them again. Number three is obviously we've got great legal frameworks for investing. Four is I think American management is the best in the world. It's hands down the best in the world. Americans work harder. They've got the right frameworks. You've got tons of videos from Y Combinator and others and Startup School and podcasts and the Stanford Entrepreneurship podcast. And, Americans care about productivity and peak performance and health and longevity. Americans are just very dynamic. The demographics are better. There's a culture of the American dream, right? So those intangibles combined with everything we discussed before go together to give the United States a compelling advantage for decades to come.
100%. I'll make just a brief comment again, everyone. If you're coming in, love interviewing Ram. How could it be nothing than long form? I know those of you in the family office world are probably not used to that. This will definitely be long form. If you haven't seen from the beginning, go and watch the replay. This is a really intense and very deep discussion around investing that honestly you don't often hear in investing or family office circles. It's all light, it's all fluff. There's no contrarian opinions, no challenging the status quo. Everything is down the middle and boring. I don't want to be that. Wrong sometimes for sure, but I hope you're enjoying it. If you don't subscribe either to Ram's platform or mine, and we're doing a little bit of a joint, more open live platform today, so welcome new audiences. I am at Family Office on YouTube, primarily, Angelo Robles podcast on Apple and Spotify, and go to angelorobles.com, simply my website. I'm most known as being the founder and longtime CEO at Family Office Association. I've been fortunate to travel the world, know thousands of family offices, create or restructure dozens of them, learn so much along the way, create my own family office in Holdco, active investor, make every mistake that you could imagine. So don't think what I'm doing is perfect, but I do look to learn. And if you want to be a part of that journey and learning and a longer form written interview, masterclass, and in-person content and programming, simply go to angelorobles.com. and join what I'm building, which is very special with incredible members at SFO Continuity in my private club. There are some questions that came in via variations of DMs in the chat feature. We highly encourage audience interaction. Off one said 100 trillion with a couple of question marks, meaning when I was quoting Raoul Paul, I'm not saying that Ram or I agree with that, although a long enough time frame, who knows? But yes, that is most definitely what he said when it came to crypto. 2 trillion now, could 50x. And I don't think he was talking 50 years. He might have been talking closer to 10 or 10 plus. Does that, you heard Ram's opinion? That appears to be a little on an extreme side to me as well. But to totally ignore it, which is what many of you did when I was actively talking about it 4 years ago, then you laughed when you were a little bit right in 2022, and you ended up being mostly wrong longer term. And likely with now Trump and getting rid of Gensler, it's probably going to be much more of a positive, even more so over the next 4 years. There was another question, Ram, that is really not as applicable to me and Ram. Basically, it's with sweeping changes to UK tax policies affecting ultra high net worth individuals, et cetera, et cetera, et cetera, how to structure assets. I will make the briefest of comments about that. In the US, we don't have much of a choice because the IRS follows us everywhere. So there's not tax arbitrage with earned income and structures in other countries. There still could be advantages, and I highly recommend multiple passports and diversity of connections, banks, and resources. But that does become even more applicable for yourself in the UK and other countries where there is more tax arbitrage. That is really not the focus of our discussion today. I have done some programs relative to that. And in your case, in the UK, I probably would also look at what's going on in the United Arab Emirates, which I have some concerns about for a variety of reasons, but there are some tremendous advantages for international type citizens as well. Ram, did you want to add any comment? Have you been to the United Arab Emirates, Dubai? And what feedback as a global thinker would you have to investors, especially non-US, that may get more tax arbitrage with diversity of holdings and earned income outside of their home country?
Yeah, I mean, tax is like its own 2-hour kind of podcast here. It's
10
crucial.
hour. Yep.
10 hours. Getting tax rate matters. There's a reason why Warren Buffett buys businesses out of goodwill so he can depreciate. He's very conscious about tax. He's very conscious about avoiding capital gains taxes. By the way, really brief on the last question, I think one other edge that the United States has is athletics and athleticism, things like the NCAA and sports and competition. There's a culture of heroism and a culture of teamwork and performance. So I think the United States is ahead on that culture. Anyway, so we can get back to the current question. So, if I recall, I don't think the UK has a distinction between short and long-term capital gains. So one of those important things is aggressive tax loss harvesting strategies. There are actually new technologies now. Actually, our team built a web page called Tax Shield. I won't walk you through it now, but there are ways you can generate a significant amount of tax loss harvest while being indexed to, say, something like the S&P 500. So you're getting the return on the S&P, but you're getting, call it like 70% of your initial principal back in tax loss harvest in year one. It kind of sounds too good to be true. These are back tested by, these are strategies run by firms in New York and Connecticut with 1,000+ people, many of whom are PhDs. But I'll share it on the screen briefly. If you go to illuminawealth.com and then under services, capital gains tax shield, check it out. That's how you avoid paying capital gains in a compliant manner while earning a return on the strategy, so long as the indices go up. There's a short answer to it. Go ahead.
No, and again, like you said, that is a little off topic for today. Yeah. I'm happy to bring it up. We gave you some light commentary. That really is a deep, deep, deep dive that we can't really do it justice in 2 or 3 minutes. And we're both US centric and based as well, although both of us are well traveled, and hopefully you got some value of, and maybe a comment that I would add that would maybe contradict slightly what Ram said. Remind yourself that don't let the tail wag the dog. Is the tail important? Sure. You mentioned, meaning Ram, the example of Buffett. At the end of the day, you may love your country, you may have family, you love whatever, the culture, the architecture, the people, and to save a little bit extra money on taxes to live where you don't want to live and make your life more complicated than it needs to be, that may not be what you really want at the end of the day. Ram, I'm going to pull up your screen now. Here it goes.
I'll be brief. Yeah, I would check this out. This is like the latest technology and how do you avoid capital gains in a significant amount. But you can check it out if you go to Limited Wealth and under Services, Capital Gains Tax Shield, and you fill out a form. It explains how to do this. So take a look at it on limitedwealth.com. But yeah, it's pretty novel. We're actually making that a core strategy for the vast majority of our clients. It's like,
love it. I have a lot of questions to go, everyone. Again, this is going to be a long form interview, and I promise great questions upcoming that on a Friday afternoon, if you're live, is definitely going to be worth your time. You hinted at this one a little bit earlier, Ram, and perhaps we're a little disagreement. I'm not sure. We'll find out. And that basically is the sentiment against fundamentals when choosing stocks. In other words, what do you look at? You know, one of my guests that I've had on, someone like Adam Robinson, who's very smart, believes in having a very limited, at least initial number of metrics. If you're an ultra conservative, old guard investor, PE ratio, PE ratio, PE ratio, value, old school, you got your ass kicked and you missed out on deep tech, variety of things actually over the last 20 or 30 years, and you're getting crushed not understanding Nvidia and AI. Now, the pendulum swing, you may be right again, quote unquote, one day, but myself, I may look at more quarter to quarter growth. I look at supply and demand. I look at some other more esoteric things that I look at, but I think the audience rather hear your comment on my comment and maybe metrics that you look at.
Sure. I'll share my screen again. It shows the growth versus value performance, the growth versus value spread. So first off, by the way, I think value is going to outperform growth. It has been outperforming growth. If you look at stocks like the cloud index, WCLD, they topped out in February. Uber topped out earlier this year. Many expensive stocks have topped out. Now, the Mag 4 names that we talked about, they're actually much cheaper than these other stocks like Snowflake, which have a forward P of over 100. Okay, so it's actually a misconception that value hasn't worked. I mean, you've got to get the right themes. Look, Bank of America stock is up 700% since 2011. Actually, any of the mega banks are up around that level, 700%, 600%, 800%. So that's a bank. Look at JP Morgan. JP Morgan, I mean, we bought JP Morgan in the banking crisis last year. Let me show you JP Morgan. I think people's eyes kind of go in the back of their heads when they see the returns because they don't expect these businesses to generate this kind of return, and they would be wrong. They'd be wrong. So the 1-year return on JP Morgan is 68%. That's pretty good. The 68% is outpacing the S&P 500, right? It's outpacing QQQ. So, yeah, I think value is going to do quite well, especially with interest rates lowering. You have companies that can refinance their debt. That's going to improve their operating earnings. It's going to take less left tail risk as well, less insolvency risk. By the way, the category that did the best after Trump won in 2016 were these value stocks and cyclicals and financials. So and that's what you're seeing happen right now. So you think growth stocks make the headlines, but if you pay a too high a price, then you don't perform. So I like growth stocks if I get a good price. We bought AppLovin, which was like I only own like 5 tech stocks, and that was one of them. I have 30 other stocks. And I can tell you we're beating the market. I can tell you that. I want to get audited returns that are GIPS compliant at year end to show you all that. But yeah, like, if you're buying ARM, let me pull up ARM. ARM is very expensive, right? How about Actually, I'm pull up an index so you get a broader based picture here. It's just not, therefore you won't see that I'm cherry picking a name or something like that. Right. So let's share my screen again. So this is the WCLD index. It's now just back to where it was in February. It's lagged considerably. It has not even come back to the 2021 highs. So imagine you were someone here saying, oh, I really want to buy growth stocks. You want to buy like Kathy Wood's ARK fund or something somewhere here because it had a big run. You're still down significantly. Now compare that to say the QQQ. It's not much better. And the QQQ, of course, is dominated by the names we've been talking about, right? Mm-hmm. So you're at all-time highs, right? So the valuation matters. Valuation even matters in growth stocks. We did a back test, actually. I did a 3-year back test, and we picked the cheapest half of all stocks in the QQQ and rebalanced quarterly. It crushes the QQQ. Buying tech stocks that have value beats owning expensive tech stocks. So I think people misunderstand growth versus value in a very significant way. Look at how many IPOs are underwater from their IPO price, often, which is when they have, peak FOMO, like SoFi, for example. There are plenty others. Rent the Runway is another one, right? Like valuation, earnings growth, competitive analysis, Porter's 5 forces, all that stuff still matters. And you should bias to value. Free cash flow, buybacks. I could show you many, many names. Let me show you one more. I love talking about stocks and markets. So this is Jackson Financial. Watch. This is a stock I own. I've written about on Twitter. The PE ratio is like 5. Okay, check this out. They reported earnings recently. Let me show you. Let me show you the returns on this thing. Overview. The 1-year return is 179%. Their total return with dividends 190%. Their PE ratio last year was 2 times. Now it's 5 times, and it's still cheap. Okay, so that's a value stock that is rivaling Nvidia. Okay, and how about another one, Innova? Okay, here's another one, and let's take a look at how they're doing here. Their overview. Okay, 1-year returns 145%. Free cash flow, buybacks. So there's plenty of opportunities. The problem is this. The growth stocks get the headlines. They get your attention. Your mind focuses on that. They're on CNBC, so you buy it, and it gets bid up. Then it's expensive. People chase with FOMO. They chase whatever's in the news, like uranium. We were in uranium before it became hot. And now everyone's buying things that are already hot. They're chasing what already worked, which is the wrong move. You have to anticipate. I'd be looking at natural gas right now. Natural gas hasn't run up yet.
Great tip. Why don't I be a little the bad guy, a little argumentative, a little bit going down a beaten path? The question effectively came in through my text. Basically, how do you approach portfolio construction, dampening or being stable, dampening volatility? If I could have a little bit of my contrarian comment, 100-year portfolio, 100 years going back 100% in stocks would be about 17,000% return, 50-50 stocks and bonds, about 3 times less. Is one more volatile than the other? Sure. If I'm a family office and I have treasuries and cash reserves, I'm good. Do we overestimate, at least in the short term, volatility? In other words, and I don't know your background, meaning the person, if you're the more traditional regular investor and you're going to retire in a year, or you're a worrywart, or you're looking to buy a house, for sure, yes, volatility does matter. If you're a family office level, I'm going to ask you to think, and this goes back to the principal and agent problem that sometimes happens in a family office. In other words, are you actually too conservative? Does the family know what their true inflation is for them, the loss of their purchasing power, and the advantage? And we'll get into being more concentrated in about 10 more minutes. But Are they too concerned about stability? And I sound like a big hedge fund manager placating to institutions. We're getting consistent 6-7% returns. The triple Q's up 22-23%. What are you so proud of?
So portfolio construction is one of the hardest problems in all of investing because it goes to the question of how do you size positions. It's an extremely difficult problem. I spent a lot of time thinking about this and iterating on this, and I don't have the right answer. I think I have a good answer, but there are a couple ways to think about portfolio construction. On the one hand, you want assets that have some diversification so that if one zigs, the other zags. That mathematically, that's just true. You get a better risk-adjusted return. You get less portfolio volatility. So most of the time, what people do, the current state of the art hasn't really changed since Harry Markowitz won the Nobel Prize in 1956 for introducing modern portfolio theory. He had this thing called the correlation matrix or covariance matrix, right? What you do is you have a table and it shows the pairwise correlations for different securities. And then you put it into an optimizer and you tell the optimizer, hey, what are the weights that I need to solve for? How much do I need to own of each asset, meaning position size me, such that I minimize the average covariance of my portfolio. You hit go and it cranks out a calculation, it cranks out an answer, this vector of what your position should be. It's such a flawed process because correlations are always backward looking, and you can have events like an election that dynamically change correlations. The day the election happened, that might have been the top in the US dollar and the top in the 10-year to the day, right? Now, your correlation matrix, because it's trained on historical data of like a year or 6 months, year and a half, it needs to wait for that training window to update and recalculate. So that's a flaw with those approaches. You can have policy regime shifts that suddenly change things. When the Ukraine war started, that was a time to buy energy, right? So are you going to wait for your correlation matrix to rethink how you look at that? When COVID vaccines came out, that was the top roughly for stocks like Zoom and Peloton. So I think more interesting ways to think about portfolio construction. I think correlation plays a role, but it's one of other factors. The other is risk reward. And this is a very common sense kind of thing, by the way, right? What's my upside versus my downside? What's the ratio of upside to downside? That's just so common sense. Now, how you get it, that's a different question, but why not position size based on the risk and reward? However, the third part is humility. Humility means that you should have diversification. Now, you shouldn't own assets that you don't believe will do well. You should have best ideas. You should have conviction. You should have ideas that you love, that you want to own, that you understand. But there should be 35 of them. Now, it takes more work to go do that. That's the cost of that approach, right? So, because diversification does work, and you can have if China does invade Taiwan, Nvidia, Taiwan Semiconductor, they'll all get smoked. Do you really want to own? Do you really want all your assets in that one thing, right? No. So, so Peter Lynch, he has this video around him talking about diversification. I read his book. In the tail end, he owned over 1,000 securities. Now, most of them are SNLs, by the way. He was doing the IPO trade on these SNLs because they're all mispriced and low. But he was diversifying across that basket of securities.
However, Ram, was he concentrated with 40% of the portfolio in like 10?
He had a good overweight on that, but he also owned Fannie Mae, for instance. That was his popular position. He owned Ford. He owned a natural gas play. So he owned quite a few different securities and ideas. So portfolio construction is an extremely difficult problem. The other thing we need to do, AI is going to unlock a new way to do portfolio construction. Here's 100%. And this is not incorporated in modern portfolio theory. Goldman Sachs doesn't have this. JP Morgan doesn't have this. I'm about to share it with you right now. Here's how it works. So think about what happened when mortgage rates and interest rates changed in the most recent cycle. What happened is people thought that home builders would get crushed because there'd be no refinancing, no one's going to move, and therefore that category would just not perform. What happened actually is they took off. because people that owned a home didn't move. If you wanted a home, you had to build a home. So home builders did well. Those classic historical correlations, what happened in the prior cycles, broke down, didn't work again. Now, a human being that was thoughtful could analyze and understand that, because it's a qualitative assessment about how consumers are going to change their behavior, right? And LLMs open up that window of analysis, right? Because risk management's hard. You've got to ask and answer a lot of questions and constantly debate yourself or others on your team around these things, right? So LLMs, if trained properly, can open up another window of risk management. For example, LLMs today should be saying, what assets in my portfolio are at most risk of AI disruption? And I think a lot of SaaS companies would fit that bucket, including Adobe, which I don't own. Adobe topped out in February. It's been a bear market since then. I'm not saying Adobe's going to end tomorrow. I'm not saying short Adobe. I'm not saying any of that. In Q4, you don't want to short much at all, actually, right? But the idea is that you can create the role of a risk manager using technology, and that can reimagine what modern portfolio theory and modern portfolio construction looks like. That's super cool. That's what we're trying to build internally, actually, technology to just change how we do investing and approach portfolio theory. These are really hard problems, but you want to know, like, where do I have interest rate risk in my portfolio? The 10 years all over the place. Where's my interest rate risk? All right. So if you can't answer that question and know which assets expose you to that, and you might want that risk depending on your view on rates. So anyway, long answer to a short question. It's the hardest question in investing, which is called position sizing. Ultimately, portfolio construction boils down to position sizing. Here's a fun fact. So I run a concentrated portfolio of like my 10 high conviction ideas, and then another 35 to 40 ideas, which are, by the way, anything I own, I have conviction in. Everything's high conviction in a certain sense. Otherwise, why do you own it, right? Fun fact, my 35, 40 name idea is beating my 10 idea portfolio. It's so funny. It's hilarious. Now, but there's a lesson in that too. So think about what Citadel and Two Sigma Millennium are doing. They're making small bets, meaning low position size, over 1,000 securities. So they're applying a small edge, like a 60% probability of being right. But they're doing it 1,000 times a day. They're in 220 days a year. And they're harvesting that alpha. And they're diversifying away all these other factor risks. Is the market up? Is the market down? I mean, they're market neutral. But the point is, if you have an edge and you have a skill, then you want to be the casino, not the player. You want to exercise that skill on a broad universe of opportunities. That's what you want to do.
I'm going to push back on you a little bit. Partially, again, these are discussions. We're not here to be nice. We're here to challenge ideas. And maybe I do like to be the bad guy sometimes. So kind of the part 1B of that question. I think you're going to agree with part of it, but disagree with the premise of it. Really, how important is diversification? Now, I'm going to use the Charlie Munger when I want to use Charlie and not when I don't want to use him. I want to have a small basket of securities and I want to watch them closely. How many high conviction ideas could I possibly have? If I have 50 holdings and I want to be equal weighted, so my best idea is number 1, and my 49 other ideas have the same weighting. So I'm concerned that too many people are over diversified. They're effectively beta huggers. They're not rolling up their sleeves. They're not doing the hard work. Now, do I think that you just buy it and totally forget it? No, but I also don't think that for 99% of us, you shouldn't also be a hyper active trader. That may also have tax implications. What I'm basically saying is, might 10 to 15 stocks be enough? Is being in multiple sectors, unlike Markowitz said, actually like a little bit of bullshit, a little bit overrated? And why do I need to do that if I have what I deem to be, other than singular stock risk, 10 to 15, and that might even be too much. Now, I'm not factoring in treasuries, some private holdings. Oh, and by the way, if I'm a deca-billionaire family office, yes, I probably want direct ownership of a lot of gold, or offshore, buying sports teams, being an LP in some of the biggest funds. That's a different animal. There's only so many of those families out there. A different subject for a different time. Where do you think, and you kind of hinted at it, where do you think I might be partially right? And where am I just missing the mark?
Mathematically, diversification works. It's just pure math. Now, you don't want to own assets that are value traps or are not going to perform. If you buy a consensus asset that's fully valued, that's dead capital. You're taking on too much risk, right? So diversification, you want to diversify across best ideas. That's a summary way to say it. You can do the 15, but it's not just about being on it and knowing the asset. You got to risk manage it. You have to risk manage the asset. Not many people can do. Most people will not have the skill to do that. Druckenmiller can do that. The key is it's not about knowing the asset. It's about, yes, that's part of it. You have to risk manage it. Meaning if you see a technical deterioration in the name, let's say you've got 3 or 4 down days in a row and now it's below the 20-day moving average, you got to sell it. Simple rule, right? So are you going to do that? Now, when you sell it, where are you going to redeploy the capital into? So I don't think many people have the skills to do a 15 concentrated portfolio and do it well. I really don't think they can. Most people cannot do that. I don't think they can pull that off. Yeah, they might get lucky in certain ways here and there. It's like if 1,000 people are in a stadium, they flip heads or tails. At the end of it, someone will come up heads 10 times in a row. But it's achievable, but it takes a tremendous amount of skill and discipline and focus to pull that off. If you're an investor at home or a family office, you don't have a shot. Like, this world is so dynamic. Every morning I have a Telegram group. I'm sharing what I see in the news, not all of it, because there's so many things I have to address in a given day, but there's so much dynamism in the modern economy and how competition is changing. There's startups gunning after Nvidia. Qualcomm is getting success in their Snapdragon chip, but Apple's trying to displace them by building their own modem. So how do you handle that information? What about Trump's policy? We talked about the 8 open areas where we need clarity on Trump's policy. You got to stay on top of that. What about interest rates? I mean, unless you're a professional hedge fund manager skill, I say that tongue in cheek, because I think most hedge funds are terrible. I know Angela and I agree on that. But like, if you're Druckenmiller, you're not Druckenmiller. You're not Druckenmiller. That means you don't have humility if you believe you are. Like, if you've got a track record that you can evidence, the fact that you're asking the question means you shouldn't be doing this. If you know the answer to the question, and which means you've evidenced it and you can perform, and you've shown yourself that you can perform, then you can do it. Then you wouldn't have asked the question.
And Ram, it may be a little off subject, but we got to keep things moving. When we were going back and forth on titles, you mentioned to put Harvard in the title. And actually, to this moment, we're going to find out in about 30 seconds. I don't know why. Now, I could take an assumption from an investing perspective, and again, being probably a little bit of the bad guy, and I get it. Harvard has $60 billion, a huge amount of money that makes it complex sometimes to quote unquote beat the market. I believe Harvard did about 9.8% last year. I could make the argument, I don't know, the S&P, the triple Q, super easy, totally liquid, crushed that. Is that something to be so proud of because it's a little bit less volatile year to year? Now, this goes back to the subjects that we just covered on looking at things more long term. So I don't know if it was that you specifically wanted to bring up, but why Harvard?
Right. Well, actually, let me double back real quick to the last question. Sometimes the processing gives another result a little bit later. I'll say this. You can own 10 or 15 assets if they are truly world-class businesses. They have no intention to sell for a long time. That's the Berkshire Hathaway approach. Coca-Cola, actually, even Coca-Cola is getting pressure because people are consuming less sugary drinks. Even General Mills is under pressure, but Visa is under pressure from stablecoin competition, right? Like,
yes.
Let's find, okay, JP Morgan. Yeah, now JP Morgan was a great idea. We talked about that earlier. Price to tangible book over 2. It's never been more expensive in the world. And Jamie Dimon is no longer buying back stock. He's selling stock. But overall, though, look, if you can find a world-class with a real moat that's not sensitive to disruption, the quality businesses, and if you're going to invest for a long time, because those businesses, those are the most expensive names in the world right now. Some of them are trading a little bit lower now. I won't name them at this point, but that theme of quality is also consensus, and it's look at FICO, for example. I used to own this name actually. Don't own it now. I think it's kind of gone in the la sphere. But this has this 84 PE business. It just reported today. It's up 8%. So, this business is not going to go away. It's not going to go away, right? They've got a monopoly position. So if you own these businesses, you can tolerate drawdowns. And there's some managers that do this, by the way. They're well known. Then that strategy will work. Okay, you just got to really know what you're doing, and make sure you've absolutely found the best businesses in that portfolio that are immune from left tail risk and competition and AI disruption and valuation compression. And that is doable though. That strategy would work. So on Harvard, Harvard's endowment's been atrocious. The portfolio has been terrible. I think it goes back to committees make terrible decisions. It's funny. I'm rereading the classics and the greats. Been having fun with that the last few months, like Peter Lynch and Mark Minervini. He's another interesting guy, and a few others. But the funny thing that comes up is they all make fun of committees somewhere in the book. There's this one paragraph around how committees are terrible, which makes sense.
Rightfully so. There's no statues to committees, by the way.
Right. And it goes back to the earlier conversation around truth. So what is the consensus mechanism for truth? What does that mean in investing even? It takes on a different meaning. See, in investing, you want to own views. You can think of views as a kind of a truth. Angela has a truth. I have a truth. Angela might have a different view on Tesla than I do. We have a different truth. You want to own views that are mispriced. You want to own views that are cheaper than the other views. It's not about being right or wrong, actually. Right or wrong is a wrong way to think about it. It's a wrong way to think about it. You want to have a non-consensus view. You want a view that's mispriced that can become consensus, which means then it's fairly priced. Now you can own a consensus idea, but then you're just going to get a consensus return. Look at Microsoft. Microsoft was consensus AI. It's lagging the S&P, it's lagging the QQQ. People said, oh, well, they own OpenAI. Okay, if everyone knows that and it's fully priced, where is your incremental return going to come from?
Excellent. I am going to move on now to probably we'll wrap up in about 30 to 40 minutes, but I do want to move on to energy and nuclear renaissance. Ram, what I'm going to do is I'm going to ask a question for about 3 minutes. I'm still here, but I'm just going to go off screen. So lucky you won't have the chance to see me, but I'm going to kickstart it. Why do you believe in a nuclear renaissance? And really importantly, a common theme today, it's all about timeline. What timeline do you see for this reinsurgence?
Sure. So, we've been excited about the nuclear renaissance thesis since last year. It was actually the first interview I had with Angelo. It was in June of last year. I was like, look, nuclear is a good thesis. The world needs more energy. That's number one. There's not enough energy to go around. Oil is insufficient, creates emissions, and the world's moving away from emissions. Wind and solar are unreliable. So nuclear is crucial. Nuclear is especially crucial now because we value the potential of AI. Nuclear has come into the fore because of AI. After Fukushima, people didn't want two things to do with nuclear. Also, the energy dependence on Russia has brought nuclear somewhat more into the fore. Now, in Germany, they were shutting down the reactors, trying to change course. But so, yeah, nuclear is essential to having an AI future. It's essential. So that's going to happen. How to play it's a different question. I believe the way to play it is through high assay, low enriched uranium. It's called HALEU. There should be futures contracts around HALEU. I think HALEU is the way to play uranium, HALEU producers specifically. So the issues with wind are wind might stop blowing. They have ecological effects, and I think they're actually pretty cool to marvel at and look at. But others think that I think they're marvels of human engineering. Actually, I don't mind having wind power, but others mind. But it won't be. It'll be a triad approach. It won't be one takes all. Nuclear is going to take years. The U.S. Nuclear Regulatory Commission will get on this in this new administration, which is good policy. It's good policy to do that. But the Americans have over 80 nuclear reactors, and we forgot how to build them. The funny thing is, the United States has over like 100 nuclear submarines out there, and they all have a small modular reactor. And the world is trying to figure out how to get small modular reactors. It's hilarious. They're on Navy subs. We have the technology. They're produced by Northrop Grumman and other in Virginia. We know how to build small modular reactors. The defense. You remember back when NASA went to space, it created all the spin-off technology. Some ranged from like Tang, a nice beverage, to like microprocessors and other technology, right? And semiconductors. But nuclear is a long journey. It's a long journey. So you need transitional sources. Natural gas is going to be one of them for sure, because it's the least dirty fuel. So I like natural gas producers and exporters a lot. I think that's not yet priced in. You can still get good valuations there in companies that are compounding earnings, and I like that. So the other I like is solar. I like solar. The efficiency on solar has gone up dramatically over the last 10 years. Like the ROI on solar is strong. So these hyperscalers have committed themselves to being carbon neutral, like energy independent by 2030, 6 years away. So they treat that as a law for themselves. Like they're driving towards that, and they can afford to accomplish that. They're going to spend and do that. So one way is what Microsoft is doing with Constellation Energy. Another way is what Amazon's proposing to do with Talon Energy. Before that deal was scuttled by the FEC. I'm sure that'll come back though in the new administration. So, but the other lever is on solar, and I think solar actually has a good role to play here too. What else on nuclear?
Well, yes, let's actually stay on this theme. I have a couple of questions. By the end of the decade, AI data centers could consume as much as 20 to 25% of US power requirements. To give the audience context, now it's about 4%. In other words, and I don't know how we could build nuclear reactors that quick, although who knows? You gave some examples. How are we going to meet this demand?
Right. Well, the answer has to be nuclear. That's number one. So, the energy demands for a data center are tremendous. So a single data center can consume something like 50 to 100 megawatts of energy. A very large data center can do 200 megawatts of energy. If you want to build an AGI, there are rumors that Amazon wants to build like a 970 megawatt data center. That is something like a 3 Mile Island, like 100 megawatts. Let's put it in perspective for you. 100 megawatts would power a medium-sized city like Anaheim, California, 300,000 people.
Yes, it's shocking.
Right. A large data center, like a gigawatt, would power Northern Virginia. Northern Virginia is like Fairfax County, DC. You got the CIA, you got a bunch of tech companies out there, tremendous energy demand. That would also be similar to like San Francisco, that area. So it's only achievable with nuclear to pull that off.
Okay, then this brings up an interesting question that ties in the race in AI, AGI, and one day super intelligence. Maybe we'll get to a little bit of that towards the end. We are massively bureaucratic. Maybe that will change a little bit the next 4 years. I'm a little skeptical, but want to be hopeful. But China, Saudi Arabia that you mentioned, they can move faster. They're already doing interesting things. I'm not saying they're going to steal IP, and some of it's open source like Meta.
They will steal IP. They have a competitive advantage in stealing IP. Yes.
Yes, I'm trying to be nice, Rob. But so now they could do that. They're not going to have the guardrails that we have. They're going to likely build and don't care about pollution. Of course, Greta's not going to talk about China or the Middle East, only about the US. They're going to have some inherent some would say cheating and other advantages, and the race to AGI and superintelligence. Listen to some of my stuff with Kurzweil and others. Whoever gets there first may win. How are we going to compete with that?
Yeah, China's got the edge on nuclear. They're building nuclear power plants, and they know how to build them, and they have less of the safety concerns, as you pointed out. And they'll be ahead on self-driving cars for the same reason. I think on pollution, they're recalibrating around that, by the way. Like, the wealthier a nation becomes, the more interested they are in clean air and clean water. They're not at the standard of where we are, but they're starting to get in that direction. But what China doesn't have is semiconductors. They don't have American technology. They're very adept at stealing that, right? They've got a version of the F-35. In fact, I think they named it something like the J-35 just to make fun of.
Right.
That's like, it's a spinning. We should put it up on screen. It's like a spinning image of the American F-35 Joint Strike Fighter. It's like someone hacked into Raytheon Martin and pulled those specs. So yeah, they have an edge there. Look, it's still the U.S. The U.S. is the presumptive winner here. The U.S. is the presumptive winner. It doesn't mean that it's inevitable. Still takes leadership, still takes policy focus, still takes, technology investment. But I think the Nuclear Regulatory Commission will relax and start opening up, enable permits. And, that's one. Two, I think the U.S. is ahead on AI, but don't dismiss China though. China AI offerings are maybe like 9 to 12 months behind. They are very compelling. The old Tencent, Baidu, Baba, they're all investing in AI. They have, we've seen those reels from OpenAI, Skunkworks. They show like a video that's 10 seconds long, and they talk about how that would enable Hollywood creators. China has that too. Very compelling. So what'll be interesting is this, like what China doesn't have is like truth, I would say, right? Like they're training from like China government point of view. There's certain truths that are just not in there. I don't think that's enough to rise to the level of competitive advantage, but it does, if you're an end user, create a preference for probably an American offering over an offering in China, right? How many people do you know that leave China and they learn about Tiananmen Square for the first time, for example, right? So they're not going to learn that through their homegrown AI. The U.S. has plenty of competitive advantages. A lot of it's just getting out of our own way. That's, which includes like from a regulatory perspective, by the way, right? So,
what do you think of Okla? That would be a nuclear play, a small modular micro reactors, and I believe was it through a SPAC that Sam Altman took that public?
I haven't looked at it closely. I'm not the kind of person by nature that would ever look at something that's so hypey like this. I think it's just a hype stock because Sam Altman's involved with it, and I think the easy money's probably already been made. These are just initial quick reactions. It's a $3 billion market cap. It's gonna be losing money. They lose $76 million a year. So if they don't make money, at some point they'll have to issue shares. When they issue shares, there'll be dilution. The cash flow from operations are negative. And let's take a look at their balance sheet. How much cash do they have? They have $105 million in cash. So, do they need to issue shares at some point? You can see the additional paid-in capital went up in 2024 by $380 million. What that means is they'd issue shares. That creates dilution. So if you invest in an unprofitable business, well, they're going to sustain themselves by issuing shares. That creates dilution for existing shareholders. It's similar to the effect of share-based compensation, right? I'm not terribly excited about these. If everyone's talking about it, you should run away. Don't invest in things that everyone's talking about.
Staying a little bit on the energy thesis, I believe energy is the second cheapest it's been relative to the S&P, which is obviously heavily weighted to the Max 7 in nearly 40 years. You could broadly invest in the XLE. Some people would say XOM, ExxonMobil, is a good quote unquote individual stock play. So getting a little bit away from nuclear and from even wind and solar, would you recommend for investors, family office level, to have some exposure to a more broader index or a specific stock, potentially ExxonMobil?
I prefer picking the stocks. That's rather than owning the index is going to do fine too. Index is actually a good idea as well, but I would prefer, for example, Shell. There's no reason to own U.S. 10-year bonds if Shell exists because you get a dividend. Shell, let me pull up Shell for you real quick here. Shell is a UK-based oil company, of course, right? It is, let me show you some of the statistics around Shell here. So this company has buybacks of 8% per year. So base case, you should at least get an 8% return. Doesn't mean that will happen, but you've got a bid about 8% or so. The free cash flow divided by the market cap is around 16% as well. So so the buybacks are sustainable. It's got a 4% dividend as well. You add 8 plus 4, you get 12%. That's higher than the average annual return of the S&P. The valuation's on the lower third of where it's historically priced, so it's cheap. So this stock has the opportunity for multiple expansion, number one. Two, earnings growth. You can see the earnings growth based on the difference in the forward PE and the trailing PE. If you divide this trailing PE by the forward PE, you're getting the implied earnings growth. So I think it's a good idea. Is it going to run fast? Maybe not, but it's better than owning a treasury bond. And it's better to buy an asset like this, I think, around where it is, if you believe that energy has bottomed, as I do. So I think this is a really interesting idea. Again, it's kind of boring, but I think boring is good. Over a longer time frame, this has done quite well. No one's talking about it. I think that's a better move than ExxonMobil. Also, Shell has a play on natural gas. I should have mentioned that too. Shell has the balance sheet, the free cash flow. They can invest in natural gas. And I think natural gas will do quite well. Oil is under pressure. Like oil demand and consumption is declining over time, but Shell has a play around that as well. So there are other plays in energy we have, by the way. Shell is maybe the most conservative play, but it's fundamentally a very good business at a very good price.
And Ram, this next question goes back to some elements of what we spoke about earlier, committees, about bureaucracy, about hierarchy, about principal and agent problem, and some of the challenges affecting family offices that could sometimes relatively easily, I might add, be addressed and change things significantly without a massive overhaul. Just simply some understanding, restructuring systems, in some ways less systems, but more effective. Too many systems create bureaucracy, but could save that for a different time. But how would you advise families to kind of streamline, almost simplify their over-reliance on hierarchy, on committees, on structure, and oftentimes opportunities like some of the private deals we mentioned? You may have to move with some sense of urgency and speed. I know your role, unlike mine, is not to go in and do a best practices and productivity in a single family office, but sometimes the best people who think about that are not entrenched in that every day, are smart, intellectual, see or think out of the box. Again, we could spend 2 hours on this subject. What would you recommend to family offices to effectively be, let's broadly go with, better decision makers?
Yes, you need a single point of accountability. That's what it starts with, a single point of accountability where you're aligned on the investment philosophy and the approach. That's where it starts. That's where it begins. You need a leader that can make decisions, and you empower that leader. You give them a framework, maybe a risk control framework around how they pursue that. That's memorialized in an investment policy statement. And you let them go do what they do, and you have to trust them. Investing fundamentally does boil down to trust, right? Like imagine Warren Buffett in 2008 buying the banks, which is a great trade. I mentioned Bank of America is up 7x since like 2011. Well, it's up a lot more from the October 08 crisis, by the way. And so is Goldman and JP Morgan. But if Warren Buffett theoretically was redeemed on, suppose he was a hedge fund, if his LPs didn't trust him, they would have redeemed and not allowed him to invest in that business. That would have been an issue. So trust is the key thing. Trust between the investor and the LPs. There has to be an alignment. Now, Buffett walks on water, so he has the capital. And that creates another edge from him. If there's a mismatch in the trust between the LP and the investor, then that creates issues. It's funny. I had an account sign up like 6 months ago or something. I bought Comcast like right before the Olympics. And he's a professional investor himself, by the way. Right. So he's like, Bram, Comcast is going the way of the dinosaurs. I don't want to own this. And Comcast up 20% since then, by the way. But leaving that point aside, the broader point is this: is like, one, that's why it's interesting. Like, if everyone thought that idea was a good idea, it wouldn't actually have performed, because it's under-owned and it's not consensus, right? But it goes back to trust. Like, if you've got to buy in every idea I have, it's not going to work. It's just not going to work, because by definition, I'm looking for a non-consensus opportunity. And that's what a good investor should be doing, because you should be looking for a mispriced asset. If you don't want to find a mispriced asset, just own the S&P. That's fine too. But if you're looking for outperformance, you got to get a mispriced asset, and you got to find something there's some variant perception. You have some mismatch between your view and what the market view is. And that requires a trusted relationship between I have clients. I'm very grateful now. They invested in QXO. They did the CoreWeave deal. They didn't fully get it, to be candid. And they tell me this after the fact, by the way. Like, they signed the docs, they read the materials, they saw the prezos. Now they get it. And I'm glad I did that. I'm like, oh, thank you for trusting me, so I can help you. That's it's a cycle. It's a cycle, right? So you have to have that. If you don't have that trust there, then you can't actually be a successful investor. It's yet another paradox of investing.
Finally, a guest who mentions variant perception before I do. So thank you, Ram. We'll go a little rapid fire, because I think I still have probably 10 questions and I don't want to tie you up forever. So, and again, keeping it a little fast paced, do you see commodities, or maybe more broadly, commodity linked assets, as a hedge against inflation? Or when I had Leon Cooperman on, when I have other guests on, aren't really good stocks the true hedge against inflation?
Yes and yes. Like, stocks are real assets. They reprice in nominal terms. So what that means is this: if inflation presents itself, stocks on average can pass through inflation in the price of their products and services. Both the revenue side and the expense side will reprice in nominal terms. They'll pay more for labor, they'll pay more for commodities, but they'll also earn more on the products and services they sell. Now, some businesses are better at passing inflation on than others. For example, consumer staples, Wrigley's, Hershey's, those stocks did well in 22. Also, energy companies, those stocks did well. So the efficiency, ability to pass through costs, it will tell you what does better or not. So yeah, stocks are great. However, nothing kills stock market returns better than inflation too. Meaning, if there's a whiff of inflation, the big left tail risk for next year, I'm not saying this is not a call I have, I'm just saying this is the risk. The left tail risk is that you get a resurgence in inflation because the Fed's cutting rates into Goldilocks. Trump election, that's equal like 50 to 100 bits in animal spirits. Then the Fed would have to start raising rates. And, that is anathema to stock market returns, especially coming off of top decile valuations where we are today. So ultimately, real assets, just like your house, house prices are up 20% from 4 years ago. So they've adjusted for inflation. But stock prices, in the journey of that repricing, they will have this kind of U-shaped curve. You want to buy them after that inflation is about to peak and then bottom out. But it's kind of a two-part answer to that question. Commodities are tricky because look at like gold miners have generally vastly underperformed gold itself. It's like, how do you play it? Well, gold's beaten gold miners. I like owning businesses overall for all the reasons we discussed. Yeah, I think energy producers would be a good hedge against inflation. I think energy companies would be a good hedge against inflation. These are complicated questions because I do think like a Trump administration will lead to more oil production. So you'll see actually lower oil prices. Kind of counterintuitive. I mean, they'll get more earnings, but the price per barrel of oil will be less. there'll be more offshore drilling, there'll be more natural gas exports, but you could actually get lower prices on the commodity price itself. And there's also no scarcity there, right? Like there's a lot of hydrocarbons out there, a lot of natural gas, etc.
Now, I'm not actually asking it because we got to speed things up directly the way the question is coming in via, we're opening this up at least now more on LinkedIn. Any specific perspective on silver?
No, I'm not a big commodities guy, to be clear as well. I like uranium. As I mentioned, no, I actually I like the Buffett school of thought on this, which is, hey, free cash flow is better than owning something that doesn't on average. I think there are exceptions to that, but I'd rather, like, on average, own a silver mine over silver, because I've got a business that can compound and reinvest in itself and invest in more mines and improve their operations. And, but I wouldn't want to buy silver miners anyway either. I'm not interested in that. I want to own financials and industrials and healthcare businesses. I think are very cheap right now, and regional banks and retailers. There are a lot of things actually to own right now, which is great. It's a good setup.
So some of the comments like John Paulson, which I think he meant if Harris won, he's going to be all gold and cash. Gold has had a great year this year. And now, again, there's a different perspective. Am I owning it or owning a comparative to it strictly from a portfolio investing perspective, or as someone who's concerned about systemic risk, about war, about global challenges, I'm owning physical gold, either in my residences, in banks, or more specifically in certain countries out of the banking system. Admittingly, like Buffett said, I may not be getting a return per se, dividends, etc., on that, but it's a hedge against certain risk. You probably don't buy as much into that argument.
At a certain level of wealth, there's nothing you should own physical gold at a certain level of wealth.
100%. Yes.
Right. And you should have it in a
meaning not 100% all in gold. I mean, definitely owning physical gold for sure.
Correct. Is it different than having an ETF format because you're relying on capital markets?
Yes.
That's where your left tail apocalypse. I don't think that's going to happen, by the way. But like at a certain level of wealth, you're supposed to check that box and have access to physical gold. So this is the chart of gold. Now, fun fact. So when Trump was elected, or at least when the market saw that he was a presumptive winner, I should say, gold essentially topped out right here. We'll see what happens now. And the US dollar also peaked. It's since rolled over. So has the 10-year. So events create changes in trend. I'm not saying that that trend's going to break anytime soon, because China is a bid and central banks for gold too. But, if it were to adjust, now's the time to be on guard for that, I would say. It's something to think about. It's right now it's got some support. It was bid at this level right here, right? Mm-hmm. So but it's something to definitely to consider. Yeah, the gold is giving the S&P a run for its money, that's for sure. But I think the S&P has also done just fine too.
Indeed. Going a little bit back to what I said earlier on data centers, on nuclear, on infrastructure, and at the breakfast you attended as my guest with my members, one of the stocks that I mentioned, I guess I'll mention it here, was IESC, which is up tremendously this year. But importantly, what the hell does it do? Because it's not a brand name to many people. It does effectively the inner infrastructure and electrical components of the data centers. So that's another layer deep.
What's the ticker again? What's the ticker?
IESC.
IESC. Okay. I'll take a look. Go ahead. It's not an American company, right? So is it a European company? IESC? Are you sure that's the right ticker?
Try. Yeah. Huh. It basically is data center infrastructure. What I'll do is I'm going to ask you a question that I'm going to look it up and we'll come
Sure.
back to that.
Yeah. Look, that's a powerful theme, the data center infrastructure
But the
theme.
theme is an incredible one. Yes.
It's a good theme. I don't know how the name itself, how you're playing it, but yeah, that's like the data center theme's been the hottest thing in the entire stock market this year. Nvidia is like the exemplar of that, but there are plenty of others at the utility.
Try IES Holdings. IES Holdings.
Okay. Let's see. IES Holdings. IESC. Gotcha. Okay, cool. So let's take a look here. So okay. I'm going to share my screen real quick. Let's take a look at this. So now is definitely not a good time to buy. That's one. Again, I don't know this thing from a hole in the wall, to be clear. So let's see here. Okay, so they're reporting earnings next month. Got a data center play. Look, it's going parabolic. These are not the times I like to go buy stocks. These are not the times to go buy stocks. They make money. They've got strong earnings growth, which is better than sales growth. That means they have operating leverage. The market cap is $5.5 billion. So, okay, somewhere between small and mid cap. It's obviously on the higher end of its historical valuations. It's being re-rated by the markets. That's evidenced by that parabola we just saw. It's got 35 times price to cash. Like I already wouldn't want to own this, but it's got a high return on equity. So it's obviously done very well, but that's all in that's all in rearview mirror, right? So yeah, look, there are other names out there that are like this, like Vertiv is one, VRT, Eaton is another one. By the way, this is my AI, Angelo. This is pretty cool, right? I typed in your ticker here. It's like my analyst, and it created a report. It created a bull bear report, and it says it's bullish. Look, I'm learning a lot quickly right away. It's got a solid backlog. We'll quantify that. Data center and residential markets. Commitment to market. It's saying all the right things. Efficient capital allocation. Valuation concerns. Boom. That was the first risk I saw as well. So strong margin improvements, robust revenue growth, backlogs 1.5 billion on a market cap of 5 billion. It's got an M&A plan. They should be doing M&A with their valuation. Low debt, strong capital allocation. You know, there are definitely things to like here, I would say. I just don't like where the chart is technically. Excessive hype, yes. You can see I trained this AI, Angela. I taught it things like hype. So this is this not
asking, Ron, what AI tool are you using? It's your internal proprietary?
Yeah, this is internal proprietary. This is sick, by the way. This tool is like awesome. How good is this? Look at this. I already know the I want to push the button. Watch this. I have a button called Tell Me Who the Competitors Are. And now I've got all the competitors here. And I can have it study all the competitors for me. And then it knows all the transcripts. I can get a view that's more precise very quickly. And Quanta, this is PWR. This is Steve Eisman's picks. Interesting. That makes sense. Part of the competitive set. I think VRT and PWR are comps. Now take a look at this chart. Check this out now. I have something called Ask the Trader. Watch this. This is very beta. Don't rely on what it says, by the way. It's like a new feature I've been building out recently. My team and I have been building out, I should say. So I'm training the LLM to interpret charts. How cool is this? I'm a kid at heart, and this is one of the toys I'm playing with. So, it says there's no evidence of parabola. I think that's wrong. I got to teach you what a parabola is. So look, it's saying technically, look, trend is up. More good closes than bad closes. It's got a strong upward trend characterized by higher lows and increasing volume on up days.
I think your AI likes my opinion, my stock.
My AI likes it, you know?
I know. Hey, I'm loving that AI already.
How funny is that, right? But this is super cool. This is why I talk about the future of what investing can look like is AI driven.
And if you don't mind me pressing on that subject a little bit, Ram, and I know this may not be to your company's personal benefit. I get it. I'm a single family office obsessed, massive advocate. As much as I say only 3% are great, that doesn't mean that it's impossible for the other 97% not to at least get better. I actually think they effectively all could, and relatively in short notice. One of the things I work on in my consultative work with family offices, what you're describing there, even if I'm not a $5 billion family office, I'm a lowly $200 or $300 million family office. AI is going to change everything, and the opportunity to create proprietary systems now based upon certain existing technologies. Yeah, it's not going to be $100 a year, but it's probably not going to cost you millions of dollars a year either. And we're not even getting into maybe more public facing AI agents for MFOs. I said in one of the debates I hosted this summer, by 2030, basically, yes, I'm being a little bit hyperbole here, but everything that we know is being flipped. Everything is changing. Don't fall behind the times. And it's very possible, technically, for family offices to take the lead, to exist in 10 years and not be swept away by all the changes going on. But sadly, unfortunately, many family offices are not going to listen to me. Angelo's too far out there. We want to be tried and true, principal agent problem. Let's go to the conservative traditional stance that I know and not push boundaries, when in reality, I'm not really pushing boundaries. I'm just talking about what's inevitable and changes you can make now to make a drastic impact.
Yeah, look, I agree. And the velocity of change and innovation is higher than it's ever been. Look, GLP-1s.
We're going to get to that.
Right. Like Novo Nordisk and Eli Lilly. Look what they did to Weight Watchers stock. Look what they did to Medfast. They're down 95%.
Yep.
Right? Gym usage at Planet Fitness is declining. Now, that's just GLP-1s. What do you think about AI? What do you think about what's going to happen with wealth management and investing, for example? That's gonna be disrupted.
They don't. Most of the people don't want to know, Rom. They, sometimes they're older executives that are going to be retiring in 5 years. Sometimes they're just simply ignorant. They, a little bit like the issue with Bitcoin and other things 4 to 5 years ago. They're busy in the day-to-day. Challenges come up every day. They don't have enough time or room in their head to understand critical thinking, how to think for yourself, how to form a thesis, and how to adapt some of the things that you need to adapt now to be relevant. It's very frustrating to me. You could probably hear it in my voice. All I know and love, especially our single family offices, and they're just like, I'm knocking on the door and they're basically opening it up and saying, yeah, we know who you are and please go away. I don't get it.
Most people prefer to lose money together in a herd, which is what the definition of lemmings are. Okay. That's why professional money managers like to benchmark to the S&P index. They can say, oh, well, the S&P's down. Now everyone feels better about themselves. Oh, because the neighbors were down too. It's like inverse keeping up with the Joneses, so to speak. But most people psychologically don't mind losing money if the benchmark is down too, right? It's a funny thing. And then when people invest, they need validation. This is not all people. Most people need social validation. Oh, so-and-so is buying it. Maybe I should take a look. And investing is a social process, right? When Bill Ackman called the 10-year as hitting peak rates on October 26, 23, it was. But that doesn't mean he got his other calls, right? It just happens because everyone was thinking at the same time. He said it. Everyone looked around and said, nodded their head, and that was it. The match was lit. So, true investment leadership requires leadership, actually. And, investing isn't a vote. It is not a vote. You're actually better off if risks are priced in and people have left the name. And now you've got people that know the name better than anyone else that are owning it. They're diamond handing it. And now there are no sellers left, right? So, yeah, I think family offices it's a paradox of investing boils down to outperformance requires non-consensus thing. You must be out of the herd. And if that's the case, what you're suggesting is on average going to sound weird. like the Build-A-Bear example I gave you, or the nuclear renaissance last year when you and I were talking about it.
Or Domino's Pizza since 2004 over a 20-year period outperforming Google.
Right. Right. Or even like these value stocks we talked about, actually. There are
Right.
plenty of value stocks that have done extraordinarily well. But the issue is this. It goes back to the media conversation we had. People consume information from the Wall Street Journal, FT, Bloomberg, New York Times. By the way, I do that too because I have to do that. I have to understand what people are discussing. But you have to have other information that's not that, right? And the best are like trade journals or going to trade shows and talking to niche experts in other fields so you can see what these trends are, right? But what happens is people focus on what's behind them, like Aklo, to your point. Oh, okay, it's all-time high. Now everyone talks about it. Okay, that means it's fully priced. There's so many eyes on it, it's fully priced. Or like Tesla popped 20% after earnings and it gave it back the week later. Okay, if you chase into it after earnings, you're too late. You have to pre-position, right? So it requires a leadership, and it's a solitary journey. Leadership by definition is solitary. You're saying not here, there. We must go there. So most people by definition are part of the herd. Cannot be otherwise. There's a distribution. So, this problem will continue forever. I don't know. One thing, like, will AI change this problem? Can AI be non-consensus? If AI consumes consensus information, I think it can be, actually. I think it can be.
I agree with you, but it would probably need to hit a level of AGI into super intelligence. There's a variety of changes that are going to occur that, again, I think society, and we have a little different perspective on that, but the world of finance and family offices, it's going to be utterly earth-shattering, and it's going to be a little scary. What's going to be created in terms of bioweapons, in terms of a new form of 10 million little mini drones? How are wars going to be fought in the future? Who's going to gain an upper hand or an edge? The number one thing when you talk to families, and you're a father, I'm a father, especially when you're over 60, your grandchildren, your children, you could have all the money in the world. What is going to be the future world that they're going to live in? Whether you're here in the US or elsewhere, why win? Why build up 100 million, a billion, 10 billion, 100 billion, $1 trillion if at the end of the day, you're not benefiting humanity, you're not being of value to society? If nothing else, the greed of your bloodline having a world that they may have a favorable edge to live in.
Well, that's a very meaningful point that you raised there. I think deep satisfaction comes from making a contribution to others and service to others, not service to self in the long run. And people either realize that or they don't. If at some point, decades and decades, hopefully from now, unless Brian Johnson's conquered immortality, I think the biggest sources of satisfaction will be hopefully having my kids around me at my deathbed and the meaningful experiences we had together, and knowing hopefully that they become good citizens and made a contribution to others.
We could do a whole thing about that. The lack of younger people being motivated to even have children, which is not just a US or a Western thing. Outside of a couple of rare regions, that basically is a trend that's happening all around the world. And although I'm going down roads that are going to be sensitive for some, I find that actually incredibly sad. So to pick ourselves up a little bit as we, I think, begin to take it to the home stretch, I'm going to make another comment that I get lots of hate on. It's meant to be a little tongue-in-cheek, but could I argue there's some truth there? And that goes back to diversification and things that I spoke about earlier. Bill Gates diversifies from Microsoft and creates a family office. Otherwise, he would have been a trillionaire. Now, yes, I know he's given money to the foundation. Take that away, he'd probably still be about 800 or 900 billion. Definitively the world's at least best known figurehead as being the richest person in the world. Is that the only thing that matters? No, of course not. I'm not saying that. But I am saying, going back to the diversification issue and going back a little bit to some of the challenges in family offices, I get it. I'm saying this to be a little comical. I know, I hope you all understand that. But where is the grain of truth there? And that goes back to concentration, to high conviction. Steve Ballmer, who has an amazing story at Microsoft, is, I think, worth a little bit more than Gates because he stayed concentrated relative to what he had.
Right. So if you like, Microsoft's the exception that proves the rule. You're literally talking about the best business model in the world. If you were to go to the Museum of Investing, in the Louvre, instead of the Mona Lisa, you'd have Microsoft. You see this operating system. You see Windows Office. You would see LinkedIn. You see their acquisition of GitHub. You see their enterprise Salesforce and customer base. You see their government Salesforce and customer base. You see the retail Salesforce and customer base. You see the search engine and billions of consumers. They're the best business in the world. But look, 80 to 90% of 2021 IPOs are below their highs. Let that sink in.
Wow.
So if you take there's a wonderful, wonderful book called Thinking Fast and Slow. I'm sure you've read it. No,
yeah, of course. Kahneman.
Of course, right. Daniel Kahneman and Amos Tversky, Nobel laureates. Well, one of them was. The other one, unfortunately, sadly passed away. And they have this framework called inside out and outside in thinking. Inside out thinking is you look at your local situation. You say, what's the best decision I can make here today? He gives an example of estimating how long it takes to prepare a course or write a book. If you do the inside out answer, you're overestimating. You assume it happens too quickly. There's a bias and there's a fallacy. It's called the planning fallacy. Outside in thinking is you look at a list of all such projects and courses and books, and you just measure the median time. And that's a far more accurate way to make a decision, outside in thinking. Right now, bringing this present context, there are 1,000 other Bill Gates, or someone that's built and sold a public tech company and taken it public. So the right the right denominator to use to measure the frequency of the diversification decision should be based on that set of events, right? Now, look, if you're a family and you own real estate and a bunch of land that's AI proof and you got a quality compounder and a real moat, just own that. Just reinvest and own that business. That's going to be great. So, but if you're in a highly dynamic, if you're a snowflake, if you're Frank Slootman, I hope that guy sold some stuff. That thing is down 50, 60%, right? So Microsoft's the exception to prove the rule. Like, humans love a good story. In the same way in the election, the story was, oh, there's a competitive election. It's a tight race. People love drama. And they use the drama to create a self-deception. The self-deception is believing, like apparently the media did and others did around, the prospects of the Harris candidacy, which you and I talked about, I think was flawed, but also in investing, right? So, I'm a philosopher undergrad, and I think they're wonderful, wonderful lessons from philosophy and investing. But David Hume says that passions are reason is a slave of the desires. Reason is a slave of the desires. What does he mean? He means that people rationalize. We have a view, and then we look for confirming evidence, and that people won the Nobel Prize making that point, as we talked about, right? So the easiest way to talk an entrepreneur out of selling their stocks, you don't want to be the next Bill Gates. You don't want to be that guy. But on average, for that set of instances, you should take those chips off the table unless you truly are owning the next Microsoft. And that takes a lot of hubris. Call me. I'll let you know if you got the next Microsoft.
Let's go into, it did make the title, a little bit of Berkshire Hathaway, a little bit of Buffett, and start with, does the passing of Charlie Munger during this year, has it had an impact on Warren and Berkshire Hathaway?
I think it has. I mean, look, Buffett by nature is a half glass empty guy. That's why he had the cigar butt strategy, for those reasons that listeners that don't know what that means. It means he was buying assets trading below replacement cost. Munger taught him about quality and focusing on longevity of cash flows and a moat, and willing to pay up for that and getting quality business at a fair price. And Buffett's just made a lot of mistakes recently. Obviously some of that's from delegation to new partners he's brought on board. He ventured into, airlines like Delta. He's buying like Sirius satellite. I look at these names. They don't make sense to me. So, he's been building cash. He's been building a war chest because he's selling securities like Apple and Bank of America that he thinks are overpriced. I think those are good decisions. He should sell those. Those will lag. Bank of America has lagged. It will lag. Apple has lagged. It will lag based on valuation earnings growth. So just look at the PEG ratio, for example. So yeah, I think he's on his second marriage, so to speak. I think he's still married to Susan, his first wife, but there's a complex relationship. He's primarily spending his time with another spouse. Even when he was raising his family, he was kind of like a checked out father, by the way. He was very intensely focused on what he does. And excellence has a price, and the price is intensity of focus. Okay, for better or worse. Now, his marriage partner is really Charlie Munger. So how can that not help but impact how you make a decision when the backdrop of your emotional set is kind of been hollowed out? I focus on getting high quality sleep every day. And the reason why is if I have bad sleep, I wake up bearish. I noticed that about me. It's really cool. I told my team that too. I'm like, hey, by the way, here are my biases. 1, 2, 3. Check for these. Call me out on these. And I owe it to you to let you know if I had bad sleep. And you can feel free to ask me too. So you de-risk yourself in a way. But I think the decision making he's displayed. I have a post on this. I've written about just examples of decisions.
That was good. Really good.
Don't make any sense. They are flawed. Other than the fact that he's selling Apple and Bank of America, he's exiting the equity markets. I think a bit too early. No, he might be right at the end of next year if inflation picks up. Though he might be right in the end of next year. It's like, between Rahm and Buffett, Buffett's probably right on that, right? If you go to the outside in view, if I just told you what I said, inside out, I think Buffett's wrong. Outside in, Buffett's actually kind of right over these time frames. But I think he's wrong though.
I did promise I would.
Yeah.
I promised I would come back to healthcare and biotech. You mentioned GLP-1s earlier. Do you see this as being a game changer? You mentioned certain stocks and industries that, like that, without even seeing it coming, have, I wouldn't say been destroyed, but are now greatly down and challenged. Some of the leading players, including Eli Lilly, how do you look at allocating in that sector and the impact that GLP-1s are going to have? And who knows, adaptations to that moving forward, medical devices in and around that, and how that creates, again, other companies that we're not even seeing coming yet.
So great question. So Novo Nordisk and Eli Lilly created this category of GLP-1s, which have not only benefits to weight loss, but apparently these are miracle drugs where your liver gets better, your cognitive function gets better. We've had these weight loss phenomena before in the past, by the way. Was it Fen-Phen? Was that the one in the early 90s or so?
Yeah, but that was a bad one that I think may have caused some heart issues.
It was a hot one before it was a bad one, by the way. It was a hot one before it was a bad one.
Yeah,
and then
true.
The FDA pulled it out and it's gone. So we'll see if this kind of miracle holds up or not. But I was an investor in Novo Nordisk, actually. And then I sold in the spring. And the reason why it was more expensive than Microsoft on a forward PE basis valuation. Microsoft's got a better business model. Their IP expires due to patent expiry and competition enters. And a story as old as time, competition enters. So I'm not excited about those names anymore. They have taken a beating. They're far more attractively priced than they were before, by the way, right? So this is a good example, like don't chase the hype. Get in before it's consensus. So I like healthcare a lot. I think healthcare is going to be a fantastic category going into next year, by the way, where we are now. Defenses are pulling back now with this Trump bump. Look at it. Oh, shit, this thing already ran up. Look at this. Wow. So I wrote my letter, my weekly newsletter comes out on Sunday, was dedicated to healthcare, by the way. Check this out. So this is 1, 2, 3, 4, 5. We wrote it here. Healthcare stocks are one of the best businesses in the world. One of the best businesses in the world. Why? Because of these demographic trends we're talking about. Number one, more people need healthcare the older you get. 2, the voters are people that consume healthcare. 3, the payers of the U.S. government on average or corporates. So, and now you have valuations that are actually attractive. They're actually attractive for the first time in a long time. I have looked at healthcare stocks for a long time. I say, they're just too expensive. When can I get these on a bargain? And now they're on a bargain. I have 20% of my portfolio in healthcare. That's a substantial overweight, by the way, for me. That's a high conviction.
Wow. Yeah, it's a high conviction theme for sure.
Yes. And med tech is a great way. So all these healthcare stocks, they sold off for two reasons. One is, first, you have the GLP dynamic we just talked about. Competition increasing is a part of that. And oversaturation of markets, prices are coming down, what you can charge. That's one. So the leaders went down. When the leaders go down, watch out for the sector. People follow the leader, right? Second, the utilization in Medicare Advantage increased. Medicare Advantage is a federal and state program. People started using health insurance more during COVID. I figured out, I never really used health insurance, by the way. Then in COVID, like we all figured out how to use health insurance. Apparently, you can get like a nice massage with your health insurance. They don't call it massage though; they call it like physical therapy. I have a sleep apnea device. I don't even qualify for sleep apnea. I'm just so obsessed with improving my quality of sleep, right? So my doctor figured out how to get sleep apnea prescribed. So I have all sorts of tests. I read Dr. Peter Thiel's book on health and longevity. Sure. So now like you and a bunch of other people, we go to our doctor. We say, can I get an APOB test? Can I get my LPL little a measured? Can I get a DEXA scan? That you don't need a prescription for. Everyone should get it. So utilization is increasing. And so health insurers are really hurting, right? So that then caused another leg down in healthcare. So you had essentially like this campfire with the sparks of Eli Lilly and Novo Nordisk lit up the leaves next adjacent to it. And then Medicare Advantage, starting with CVS, actually, that was the first to go down. Then it became interesting. Then I actually got into that position after the house burned down. It's cheap. But then all the other insurance from Elevance, United Health, they also burned down. But then pharmaceuticals sold off and medical tech, which are beneficiaries of higher utilization. Because one of the tests is, hey, my wife, she had an issue with her hand, feeling some pain. I'll give her like an MRI. What the hell are you giving like an MRI? I'm glad for my wife. I feel bad as a taxpayer though. An MRI, how many thousands of dollars is going into this thing? So the whole category just sold off. It's cheap, earnings growth. It's counter-cyclical too. It's just not cyclical. That's the whole point. So they're wonderful businesses in the healthcare category, and finally they're on sale. So when that happens, you want to be contrarian. No one's talking about it. Who's talking about healthcare? Is anyone talking about healthcare now? They're talking about AI data center. We were talking about that too last year with Nvidia and Meta and Google. So you want to be contrarian. That's what you should be focused on.
Of course. Boy, that's a lot there. We're heading to the home stretch. I did promise the audience I would rattle off some other stocks, get your opinion, and then we'll call it a day. Or for those of you live heading into the weekend, I hope you're enjoying it. Don't forget, go to my YouTube at Family Office and a smaller one at Family Office TV and the podcast, Angelo Robles Podcast on traditional platforms, and go and subscribe. I hope you're really enjoying my time here with Ram. I probably didn't cover, less so from the investing perspective, more so a bigger picture of AI as much as I wanted to cover, because it's such an important topic that I write proprietary content on, do unique interviews, including with prominent people. When we have Ram Bach, which is historically every 6 months, so April or May in 2025, you watch, and I'm not ignoring the investment part of it. Just watch the advancements that we're going to see. Specifically, keep an eye on AI agents. There's going to be so many advancements. This industry and everything, it's warping and changing what we know in the world of wealth management and family offices and really everything. And again, I'm going back again saying you all have to get in those communities far more familiar. Maybe do it over the holiday season than you're doing now, because many of you, unfortunately, are way behind. And yes, that is one of the advantages of joining and being a part of my SFO continuity. The amount of writing, the work that I do on upcoming superintelligence and a lot of the risks that are going to be faced and opportunities now and technologies, a tech stack to effectively get an edge. including investing in public and private companies and all the programs that I put on around this subject, that very, very few, I mean, really no one is covering, nowhere near the depth that I am. It's not even close in the family office world. But to the traditional, it's looked at as that's a little fringe, it's crazy, it's outside. And let's talk about the good old traditional things that you've been talking about for 50 years that really aren't moving the needle. On that wonderful and cheery note, everyone, Ram, this will be, I think, my fourth interview this year that will break the 3-hour mark. So awesome. I promise we're going to wrap up in a couple of minutes. I'm going to rattle off some stocks, some of them big names and pretty traditional, but maybe a little bit under the radar, maybe dividends, maybe opportunities, etc. And others, I did mention one, Sweet Green, earlier. What do you think? And I believe it was one of Munger's favorites. What do you think of Costco?
Costco is a world-class business. It's way too expensive. I would not be buying it here at all. That doesn't mean that it won't go up. This is something people need to understand, is like, you have to measure an investor by their process, and is it repeatable? Like, it might go up. A lot of things are going to go up this quarter, by the way. But that doesn't make it a good investment. Costco's forward PE is 53 times. I'll share my screen again here. So Costco is more expensive than Nvidia. I'd rather own Nvidia. So, but it's a world-class business. In the next bear market, this is the name that you want to be buying. Let's take a look at the valuations here. It's at the upper percentile of valuation. The price to free cash flow is 63 times. Now, they'll have earnings growth, but therefore, you got to wait a generation to get your principal back. Is that a good investment? No, it's not a good investment. I'll give you a better investment. Bumble. Let me compare this to Bumble. Who's talking about Bumble? No one's talking about Bumble, right?
Of course not. I don't think most people in my audience know what it is.
No, they don't. It's a dating site, right? Look at this. This business.
Yes.
They're buying back, 36% of their stock? Look, this is the opposite of Costco. See, all green here. By the way, that's not always a buy signal. It could mean a value trap, right? Investing is hard, as I said. I don't want people to walk away and think it was a magic formula. But the buyback is 36%. People, what does that mean? The denominator of shares is going down. Okay, now, what's the second question? Are earnings going up? Or is revenue going up, right? They have taken out some debt. Okay, is the debt manageable? Yes, that's based on my analysis, not financial advice. Yeah, it's a 6.4 PE. Now, look at, if I told you can buy a business and in 6 years you get your money back and the business is still running, would you buy that as an owner, from an owner mindset? Yes. If I could buy this in the private markets at 6 times forward earnings, I'd buy it. This is one of the cheapest assets in the world, I believe. So,
and yes, I'm sorry, Ron.
No, yeah. So like that's an interesting idea. That's a non-consensus. And how has it been working? Funny thing, I got in this thing in February. I thought it was cheap. It didn't work. I sold it. Risk manage is key. People make the mistake, hold it for no. Get a stop loss. It doesn't work, sell out. Okay. Now I'm back in. It capitulated. And I'll show you that. And take a look at this right here. Bumble on the chart here. So in this moment in time, here, all the bad news got priced in. Stabilized, going up. Doesn't mean it's going to go up in a straight line, et cetera, et cetera. But in 3 years' time, how is that not up double digits versus the S&P? I would suggest. Maybe in 1 year's time, right? That's a better idea, though, than Costco.
There's other factors that come into play with that as a dating site, which basically people under 40, definitely under 30, the old days of just randomly approaching, of friends introducing, of workplace are less popular now with younger people. A lot of it is online. So there's certain bigger picture trends relative to that stock that do look attractive.
Usage is declining of Match, Tinder, all this stuff. Like there's reasons why it's cheap, just to be clear, right?
Exactly.
That's why I thought not a growth stock. That's also priced in my view. So this is the funny thing about non-consensus investing.
I mentioned SG, Sweet green earlier.
Yep.
I don't know if you wanted to pull something up or
Yeah,
give your.
I will. So I used to own SG and Shake Shack at the beginning of the year.
That was coming up. You beat me to the punch.
Yeah, I did. I wrote it on Twitter. Folks made good money on it. I'm happy for that. I don't own it now, and I wouldn't own it now because restaurants are way too expensive. Now, calling the top of these can be hard. Let's take a look at Sweetgreen. Put it on screen. The whole restaurants category is expensive, and this bubble will burst sometime the next 4 to 5 months, I would say. Maybe it happened today. I don't know. It's down 7%. We'll see. But this business is worth $4.5 billion. And, if they can sustain a 20% plus revenue growth for the years ahead, it's probably good business. They've obviously achieved that in recent years. I don't know what happened in September 24. I don't track it as closely anymore. If I look at, the key thing with a restaurant business is you want to make sure they have a high enough ROE to compound. So ROE is negative. You really have to get into the accounting and financial statements on this one because let me take a look at free cash flow real quick. So if they have enough free cash flow to reinvest in growth, meaning open up new stores, what you call restaurants, right? And then if each new investment is NPV positive, meaning it generates more cash outflow than the cash inflow required within a reasonable time frame, like 3 years. If they can open 100 of those and each investment's NPV positive and they can self-finance their growth, that's a classic quality compounder. That's why Domino's Pizza did well, by the way, because it had those qualities. That's also why Costco did well. That's also why Peter Lynch did extraordinarily well owning restaurant stocks in the 80s and 90s. The problem is that now they're all so expensive. You're not getting what you paid for. The cash flow from operations here is 46 million. That's quarterly. Let's take a look. I mean, we should be looking at forward estimates, I suppose, but you got like 100 times price to free cash flow here. So I think this category as a whole is just very overpriced. Peter Lynch would look at the PEG ratio, and I think that's appropriate for a name like this. It's not appropriate for all names, but it's appropriate for a name like this, a growth stock.
And I'm assuming it's going to lump into it, but they had a great year and a great year last year. The iconic, of course, Texas Roadhouse.
Yeah, what's the ticker for Texas Roadhouse again? Wing? No, there's Wing is a different one. Yeah, TXRH, right? Okay. Yeah. By the way, this is great for my AI tool. I can actually I have a restaurant's theme, and I can load up all the restaurants at the same time. I'll show you this. And this is pretty cool. So let me share my screen there again. And okay, cool. Check this out. So we've got them all in here. Starbucks, Chipotle Mexican Grill, Wing, and I've got a buy-side quality report on all of them, almost all of them. I guess I have to generate them for some of these. There's Yum Brands, there's Taco Bell, there's Sweetgreen. So Sweetgreen. All right, good. So 9% same-store sales growth. That's an important metric to look at. Think of them as a retailer. Conceptually, that's what the idea is, right? You have a bunch of stores, and they should have a year-over-year growth. Anyway, I won't spend too much time on this one, but Texas Roadhouse was a TXRH?
I think so, yes.
Yeah, that makes sense. So the factors aren't so bad here. Actually, factors are actually pretty good. So these are my quant model says, hey, this is not so bad, but you got to compare. You got to look at the quantitative and the qualitative together, right? It's less sensitive to the market, has good ROE. It is expensive, but not, according to this model, not awfully expensive. I'm sure it's ridiculously expensive though when I fact check the model, right? So it's going to take 2 minutes to build that because actually it's going over the web and trying to ingest data like a flux capacitor and get a point of view. But if I look at this name. Look, and again, Q4 up, right? We should be at S&P 6,000 now. So, there's a difference between short-term and long-term, and, should you buy it now versus if you already hold it? So, I mean, this isn't as egregiously priced as some of the other ones. It's got a great ROE. This is a quality compounder. They can reinvest in their own growth. It's definitely better than like a Kava, right?
Which is very trendy for investors. Yeah.
Correct. So if you look at, say, a Kava, so if you look at a Kava, up 4% today. This is pure Momo now, right? 390 trillion PE. You have to wait. If you're a vampire, you will get a return on your capital one day. Yeah. This is a Brian Johnson longevity stock. So, I mean, this is ROEs. I don't know why. It should be higher, actually. It should be higher. 7.4%. Texas Roadhouse is better. Again, this is just quick analysis.
No, that's amazing. And you're going to make that AI tool, like you said, perhaps by the time I have you on late spring or so. And by the way, so much is going to change. Just look at that. Heading into 2025, what's going to happen with AI agents? What's going to happen with your thesis on the restaurant stocks outside of maybe Texas Roadhouse that appears to be just kicking butt with pretty good metrics moving forward? Healthcare, biotech. We're going to be a couple of months deep into the Trump administration. I mean, there's just so much, to me, excitement and opportunity and things going on, but you gotta keep your eye on the ball. You got to be open to opportunities. I see you pulled up another screen.
Yeah, I'll show you this real quick. This is Chipotle Mexican Grill. In May, I said, correct. This is Bill Ackman, one of his top holdings. He's been selling it down. Wait, CMG. This is CMC. In May, I wrote this is not a stock you want to own. And then Bill Ackman came out, published his 13F, showed he was selling it. It's obviously down from there. It's recalibrated. It's back on trend. We'll see what happens. But again, it's more expensive than Nvidia. The general point, though, is that many restaurant stocks will experience something like this. It's going to re-rate and recalibrate because it's too expensive. And, Palo Alto Networks are the same thing. Cyber stocks, very expensive. They'll move up, then they'll calibrate and re-rate down here. It got back on the 200-day, and now it's more of like a momentum type of play right now. So it's not a fundamental underwrite. You're writing like a momentum bet.
And maybe the last one, Ram. I had a guest on a couple of days ago that mentioned N as in Nancy, V as in Victor, R as in Robert. I believe it's a real estate play. I don't know if you wanted to pull it up, but he was extremely enthusiastic about it.
What's the name of it? NR, what's the ticker?
N as in Nancy, V as in Victor, R as in Robert.
Okay, let's take a look. NVRB. I'm not seeing anything come up there.
NVR, just N.
Oh, NVR.
Yes.
I think I've looked at this business actually. Yes, of course. Home builders.
Yep, that's it.
So I have looked at this, not deeply. I haven't looked at this deeply, just to be clear. So, okay, let me share my screen here. And just give me a moment here. So my pick in home builders, by the way, is MI Homes, MHO. They reported earnings. They've done quite well. It's the cheapest in the category. Good buybacks. Home builders are tricky now, just where mortgage rates are. It's a tricky category. We were buying like in April of last year. I'm actually not adding to it now. You should look at the backlogs for these home builders and see if the backlogs can allow them to sustain earnings. I do think mortgage rates will come down though. So this is expensive, like 19 times. This is expensive right off the bat. You can see how pricey it is, right? Look at that. So let me compare this to MHO. And let's see who did better, by the way. Let's compare these two. Watch.
Sure.
MHO, 8 times forward per E, trailing 9. Okay. What's the 1 year return on this? 76%. This is a value stock, clearly, right? MHO. What about NVR? 1 year return, 57%. Not as good as MHO, at least historically. Now, historically isn't forward looking, obviously. Let's take a look at this. So price to free cash flow 23 times. It's pricey. It's pricier than the S&P 500. That's expensive. Free cash flow 4%, not bad. Buybacks 5%. I like that. The ROE is great. These are all classic patterns for home builders, by the way. Good ROE. They can invest in themselves. They can create mortgages for their own customers, which is nice. Now, they will actually have better metrics on this than MHO. That's also why it's got a higher valuation. So here the buyback's a little bit less. The return on equity is less, as I mentioned. but it's a bargain. Price free cash flow. It's actually elevated, but on an earnings basis, it's much cheaper. So I think it's a harder question there. I think with NVR, I don't know. I might prefer. I prefer starter homes. Like KB Home's a starter home play. I don't own it, but I like that idea because of housing shortage. Yeah, people want low priced homes, entry level homes.
Boy, talking about going old school. One final one. How about Philip Morris?
I like it.
All right.
I like that one. Philip Morris. I own it. I own that one. Druck owns it too, by the way. I don't own, but I look at 13F filings to get idea generation.
Of course, we all do.
Yeah. Of course. Not we all don't, Angelo. We all should.
Yeah, let's not tell everyone our secrets.
Right. And by the way, don't copycat. You still have to do the analysis. Like you can't
100%. And it's past a little bit historical.
Yeah. Philip Morris. So the case for Philip Morris is actually around these around vapes. So let me share my screen here. Actually, I had a good entry like 2 days ago, by the way. Had a very good entry 2 days ago. Boom. Look at that. 2 days ago, right there. See, if you want to perform, you have to know things like that, right? If you're not on the ball, then someone else is going to eat your lunch. That was the entry. Okay. Now up 2.3%. Good. Now, questions, do you buy it here? And the valuation, it gets more complicated. It's better if you can originate an idea to get ahead of the curve, right? So it's not a bad idea. It's not a bad idea, I would say. So again, I have a small position here, just to be clear, but yeah, I do own it, and I think it's you can see the thesis. Yeah, look, it's got all the things I like. $1.5 billion in free cash flow. We like free cash flow. Free cash flow. Yeah, it's got a reasonable debt to equity ratio. Wait, this is the wrong one. This is Permian Basin. What am I talking about here? Permian Basin is a very different play. That's an energy idea. There you go, Philip Morris. Okay, there we go. Dividend yield 5%.
Nice.
Okay, the PPS. Okay. So, yeah, it's a overall. I would say it's a good idea. It's a good idea.
Yeah. Well, Ram, this did break my record at 3 hours and 16 minutes. So kudos. It takes the cake. It's been an honor and a pleasure.
Always a pleasure.
I'm sorry, Ram?
Well, it's always a pleasure. Thank you again. Look, if Trump can do 3 hours and Joe Rogan, you and I can manage, right?
In closing comments, a reminder, this is during the week. It's after the fact of the election here in the U.S., so it's early November 2024. We have Ram back, as always, in about 6 months, and trust me, so much, as I mentioned earlier, to discuss. And by then, 2 prominent, very public in-person programs would have already been done. I'm doing a interesting family office program at the Breakers in Palm Beach in March, and I really look forward to that. Go to angelorobles.com and join so you could be a part of that. Maybe we could talk Ram into joining us at the Breakers come early spring. And like I said, in April in New York, so just a couple of weeks after that, the 10X Investment Summit, and really look forward, hopefully getting Ram there and others. And like we did today, but even more so in person over the course of even longer and more targeted, really focusing in on those what could be exponential opportunities. But as always, when we're talking investing, do understand this is for entertainment and engaging purposes. Conditions change rapidly. You might hear this, and a week later, a month later, simply the thesis for either of us simply changes. So you have to look at it from entertainment and engaging purposes for you, the watcher, the listener, to think for yourself. My interview with Michael Saylor and others, the smartest people, what they get out of these amazing schools, MIT, Harvard, they hope to the ability to understand how to think for themselves. Everyone has different risk tolerances, different time horizons, liquidity needs. And when you invest, you can absolutely lose money. Do you understand that? Of course, investing could be profitable. It could also be risky. Think for yourself, make your own decisions. This is our opinion and for entertainment purposes at this specific time. That could change later today or tomorrow. I don't know. So on that note, I hope you enjoyed the longer form conversation today. I'm Angelo Robles. For many of you that are newer, go to angelorobles.com, have a chance to learn more about my decades of experience as an entrepreneur and in specifically the single family office community. That is my love. That is my obsession. I travel the world meeting incredible families, single family offices, learning so much, hopefully imparting some best practices and productivity and investment knowledge onto them. And it's a labor of love. It's really all that I've ever known in my professional career, which does go back decade after decade after decade, that truly I became obsessed about. And for me, obsession drives me with my passion and focus in terms of what I want to do and the work that I do in a niche community. Am I a little bit different, a little bit seeing around corners, and again, sometimes wrong? I mentioned many of this throughout the podcast. This is a boring vanilla industry. I wanted to rock it. I wanted to change, to shake it up. And sometimes that leaves me a little bit of an outsider in the community, but I'm doing great. I love what I do. And I would love for many of you to go to my YouTube at Family Office, go to angelorobles.com, be a part of it, join, subscribe, immerse yourself in terms of what I'm doing with my content, both digital and writing, and definitely in-person programs. Ram, I'm now going to give the floor to you for closing commentary and how people could learn more about you, follow you on X, and learn more about Lumina.
I'll be brief. First off, thank you again for the time, Angelo. It's always a pleasure. I love the far-ranging set of topics and how you approach the synthesis, and you're a non-consensus individual too. So that's it's always a real and a citizen of the world too. So it's great to get your perspective and have this back and forth. But you can follow me on Twitter at Ram Ahluwalia. It's a mouthful. If you look at the comments, you can find my handle there. Also, I have a Sunday newsletter, comes out every 11 a.m. Eastern time. It's called the Lumina Ledger. I posted the link in the notes in the chat window there. You can take a look there. And then also on TikTok, Instagram, LinkedIn. So we're social media forward. So hopefully you can find the right format that works, for you.
And I'm going to spell Ram's last name for those of you that didn't see what he posted in the chat. Last name would be Ahluwalia. That's Ram, R-A-M, his first name. Ram is an incredible resource. He's already popular, but still greatly non-consensus. I'm shocked that he's not on Joe Rogan, that he's not on Tom Bilyeu and Chris Williamson. And then he's going to look at and say, why go on Angelo's show? He doesn't have any followers. So I discovered before you became ultra popular, Ram, don't forget, I've known you for 15 years.
It's always a pleasure, Angelo. Looking forward to the next time we get together. Thank you again. Really appreciate it. Always
Thank
fun.
you, everyone, our watchers and viewers, listeners, those that hear this in a recording. I hope you enjoyed it. Thank you all so much. And thank you, Ram, for being such a great guest and so cordial with your time. Thank you and have a great day and a great weekend.
My pleasure. Take care now.
Thank you.